1. Understanding dividends. 1.1 Introduction to dividends. Dividends are a form of a payout that companies distribute to their shareholders. They represent a portion of the profits earned by the company and are usually paid out in cash or additional shares of stock. Dividends are an important component of investing, particularly for income-seeking investors who rely on these regular payouts to generate a steady stream of income. In this section, we will explore the basics of dividends, including what they are, why companies pay them, and their importance in building wealth through the power of compounding. Definition. Dividends can be defined as the distribution of a company's earnings to its shareholders. When a company generates profits, it has the option to reinvest those profits back into the business for growth or distribute them to its shareholders in the form of dividends. Dividends are typically paid out on a regular basis, such as quarterly, semi-annually, or annually. Purpose and benefits. The primary purpose of dividends is to reward shareholders for their investment in the company. By distributing a portion of their earnings, companies offer shareholders a share in the profits they generate. This can be particularly attractive for income-seeking investors who rely on dividends to supplement their regular income or fund their retirement. Dividends also play an essential role in the power of compounding. When dividends are reinvested back into the purchase of additional shares, it can lead to exponential growth over time. Due to compounding, the total number of shares a shareholder owns increases, and as a result, the amount of dividends received also increases. This allows for the potential for accelerated wealth accumulation. Dividend stocks. Not all companies pay dividends. Some companies choose to retain their profits for reinvestment in the business or other purposes, while others may not generate consistent profits. However, there are many companies that do pay dividends and are considered dividend stocks. Dividend stocks are typically well-established and stable companies that generate predictable earnings. They are often found in industries such as utilities, consumer goods, healthcare, and financial services. These companies tend to have a history of distributing dividends consistently, making them attractive to income-seeking investors. Factors affecting dividends. Several factors can influence a company's decision to pay dividends. 1. Profitability. Companies need to generate profits to have sufficient funds to pay dividends to shareholders. A company's profitability is a crucial factor that determines its ability to pay and sustain dividends. 2. Cash flow. Companies also need to have enough cash flow to support dividend payments. Even if a company is profitable, but it lacks adequate cash flow, it may not be able to pay dividends. 3. Financial health. Companies with a strong balance sheet, low debt levels, and healthy liquidity are more likely to pay and increase dividends. Investors typically look for financially stable companies that can sustain dividend payments over the long term. 4. Business cycle and industry trends. Economic conditions and industry trends can impact a company's ability to pay dividends. During periods of economic downturns or industry-specific challenges, companies may reduce or eliminate dividends temporarily. 5. Company policy and strategy. Each company establishes its dividend policy based on its unique circumstances and strategic objectives. Some companies may prioritize dividend payments to attract income-seeking investors, while others may prioritize reinvesting profits for growth. Conclusion. Dividends represent a crucial aspect of investing, providing a source of income for shareholders and an opportunity for wealth accumulation through the power of compounding. Dividend stocks offer stability and predictability for income-seeking investors, allowing them to generate consistent returns over time. Understanding the basics of dividends is essential for investors looking to maximize their dividend returns. In the following sections, we will explore different types of dividends, such as cash dividends, stock dividends, and special dividends, as well as important metrics to evaluate dividend stocks, such as dividend yield and dividend payout ratio. 1.2 Types of dividends. Dividends are a key component of many investors' strategies, especially for those seeking to generate a regular income from their investments. However, not all dividends are created equal. In this section, we will explore the different types of dividends that investors may encounter. Cash dividends. Cash dividends are the most common type of dividend and involve the distribution of cash directly to shareholders. When a company generates profits, it may choose to distribute a portion of those profits to its shareholders in the form of a cash dividend. Shareholders receive these dividends on a per-share basis, typically expressed as a certain amount of money per share held. For example, if a company declares a cash dividend of 50 cents per share and an investor holds 100 shares, they would receive $50 in cash. Cash dividends are attractive to investors who rely on regular income from their investments. These dividends can be used to cover living expenses or reinvested into other assets to generate further returns. Cash dividends provide investors with a tangible and immediate benefit, as they receive cash directly in their brokerage or bank accounts. Stock dividends. Stock dividends, also known as bonus shares or scrip dividends, are dividends that are paid in the form of additional shares of stock. Rather than receiving cash, shareholders receive additional shares in proportion to their existing holdings. For example, if a company declares a stock dividend of 5%, a shareholder who owns 100 shares would receive an additional 5 shares. This means their total number of shares would increase to 105. Stock dividends are essentially a way for companies to distribute earnings while retaining their cash. They allow companies to reward shareholders without depleting their cash reserves. From an investor's perspective, stock dividends can be beneficial as they increase the number of shares held. Over time, if the stock price appreciates, the value of the investment can also increase. However, it is important to note that stock dividends do not provide immediate liquidity, as they do not generate cash that can be spent or reinvested. Property dividends. Property dividends are less common than cash or stock dividends, but they can be an interesting alternative for both companies and investors. Instead of distributing cash or additional shares, a company may decide to distribute physical assets or securities of another company to its shareholders. Property dividends can take many forms, such as distributing shares of a subsidiary company or distributing assets like real estate, commodities, or even other financial instruments. These dividends allow companies to divest non-core assets or to provide shareholders with exposure to other investment opportunities. From an investor's perspective, property dividends can be both a blessing and a challenge. On one hand, receiving assets or securities directly can provide diversification and potential long-term value. On the other hand, it may require additional effort and cost to manage and liquidate those assets if the investor prefers cash or other forms of income. Special dividends. Special dividends are one-time, non-recurring payments made by a company to its shareholders. They are typically declared when a company has exceptional profits, a large cash reserve, or a significant event such as an asset sale or a windfall gain. These dividends are in addition to any regular dividends that a company may pay. Special dividends are often larger than regular dividends and can provide a significant boost to shareholders' returns. They can be a welcome surprise for investors and can result in immediate gains. However, it is important to note that special dividends are not guaranteed and can vary from year to year. Investors should not rely solely on these one-time payments but consider them as an added bonus. Dividend type summary. In summary, there are several types of dividends that investors may encounter: cash dividends, stock dividends, property dividends, and special dividends. Each type has its own advantages and considerations, and investors should carefully evaluate their investment goals and needs when selecting dividend stocks. Understanding the different types of dividends can help investors make informed decisions about which companies to invest in and what returns to expect. By diversifying their dividend portfolio across different types of dividends, investors can potentially maximize their income, manage risk, and build long-term wealth through the power of compounding. 1.3 Dividend Yield. The dividend yield is a fundamental metric that investors use to evaluate the attractiveness of a dividend-paying stock. It is a simple ratio that provides insight into how much dividend income an investor can expect to receive in relation to the stock's current market price. Defining dividend yield. The dividend yield is expressed as a percentage and is calculated by dividing the annual dividend per share by the stock's current market price. It represents the amount of cash flow that an investor can potentially earn from holding a stock in the form of dividends. Dividend yield equals annual dividend per share, stock's current market price, x 100. For example, if a stock's annual dividend per share is $2 and its current market price is $50, the dividend yield would be 2/50 x 100 equals 4%. Evaluating dividend yield. Dividend yield is an important metric for investors who seek income-generating investments. A higher dividend yield indicates a greater return on investment through cash dividends. However, it is crucial to understand that a high dividend yield alone does not necessarily make a stock a good investment. It is essential to evaluate other factors such as the company's financial health, dividend payout ratio, and dividend growth rate. Factors affecting dividend yield. There are several factors that can influence the dividend yield of a stock. Company financials. The financial strength of the company plays a significant role in determining the dividend yield. Companies with stable earnings and strong cash flows are more likely to offer consistent dividends, resulting in a higher yield. Market conditions. Dividend yield can fluctuate based on market conditions. During periods of economic uncertainty or market downturns, stock prices may decline, resulting in an increase in dividend yield. Conversely, during bull markets, stock prices may rise, leading to a decrease in dividend yield. Dividend policy. Each company has its own dividend policy, which determines the percentage of earnings that are distributed to shareholders as dividends. Companies with a higher dividend payout ratio tend to have a higher dividend yield. Sector differences. Different sectors have different average dividend yields. For example, utility companies and real estate investment trusts, REITs, often have higher dividend yields compared to technology or growth-oriented companies. Interpreting dividend yield. The dividend yield provides investors with a snapshot of the expected return through dividends. A higher dividend yield suggests a higher income potential for investors. However, it is important to consider the overall investment strategy and goals since high dividend yields can sometimes be a result of stock price declines or market uncertainties. Investors should carefully analyze the company's financial stability, dividend growth potential, and future prospects, rather than solely focusing on the dividend yield. A sustainable and growing dividend is often more valuable in the long run than a high yield that may not be maintained. Limitations of dividend yield. While the dividend yield is a useful metric, it does have certain limitations that investors should be aware of. Market volatility. Dividend yields can change rapidly due to fluctuations in stock prices. A sudden drop in stock price without a corresponding reduction in dividends can result in an artificially high yield, which may not be sustainable. Share buybacks. In some cases, companies may choose to buy back their own shares instead of distributing dividends. This can increase the stock's price and lower the dividend yield, even if the total dollar value of dividends remains the same. Dividend cuts. Companies may reduce or eliminate dividends due to financial difficulties or strategic reasons. A significant reduction in dividends can significantly impact the dividend yield and the attractiveness of the stock as an income-generating investment. Interest rate changes. Dividend yield can be influenced by changes in interest rates. When interest rates rise, dividend yields may become less attractive in comparison, impacting the demand for dividend-paying stocks. Conclusion. Dividend yield is a critical metric for income-focused investors seeking cash flow from their investments. It provides a straightforward measure of the proportion of dividends relative to the stock's current market price. However, it is important to consider dividend yield in conjunction with other factors such as the company's financial health, dividend payout ratio, and future growth prospects. By evaluating these factors comprehensively, investors can make informed decisions about the potential return on investment from dividend-paying stocks. 1.4 Dividend Payout Ratio. The dividend payout ratio is a key metric used by investors to evaluate the sustainability of a company's dividend payments. It measures the percentage of a company's earnings that are distributed to shareholders in the form of dividends. By understanding and analyzing the dividend payout ratio, investors can assess whether a company has sufficient earnings to support its dividend payments over the long term. Calculation of dividend payout ratio. The dividend payout ratio can be calculated by dividing the total dividends paid by the company by its net earnings. The formula for calculating the dividend payout ratio is as follows. Dividend payout ratio equals dividends paid, net earnings. The result is expressed as a percentage, representing the proportion of earnings that were distributed as dividends. For example, if a company has $10 million in net earnings and paid out $2 million in dividends, the dividend payout ratio would be 20%, $2 million per $10 million. Interpreting the dividend payout ratio. The dividend payout ratio provides valuable insights into a company's dividend policy and financial health. A high dividend payout ratio indicates that a significant portion of the company's earnings is being paid out as dividends, leaving less money available for reinvestment and future growth. Conversely, a low dividend payout ratio suggests that the company is retaining a larger portion of its earnings to fund growth and expansion. It is important to note that a high dividend payout ratio does not necessarily indicate financial instability or poor management decisions. Some mature companies with stable cash flows and limited growth opportunities may choose to distribute a large portion of their earnings as dividends to reward shareholders. On the other hand, growth-oriented companies may retain a higher proportion of earnings to reinvest in the business for future expansion. Factors affecting the dividend payout ratio. Several factors can influence a company's dividend payout ratio. These factors include industry norms. Different industries have different norms and expectations regarding dividend payout ratios. Some industries with stable and predictable cash flows, such as utilities and consumer staples, may have higher payout ratios. In contrast, industries with high capital requirements and higher growth potential, such as technology or biotechnology, may have lower payout ratios. Business cycle. The business cycle can impact a company's earnings and subsequently its dividend payout ratio. During economic downturns or periods of instability, companies may reduce or suspend dividend payments to conserve cash and maintain financial stability. Conversely, during periods of economic prosperity, companies may increase dividend payments as their earnings grow. Growth opportunities. Companies with significant growth opportunities may retain a higher portion of their earnings to invest in research and development, acquisitions, or expansion. As a result, their dividend payout ratios may be lower compared to companies in more mature industries. Dividend policy. Each company determines its dividend policy, which includes factors such as the target payout ratio and the frequency of dividend payments. Some companies may have a consistent dividend payout ratio, while others may have a variable ratio based on their earnings performance. Importance of the dividend payout ratio to investors. The dividend payout ratio is an important metric for dividend investors as it provides insights into a company's dividend sustainability and financial position. By examining the payout ratio, investors can assess whether a company is generating sufficient earnings to support its dividend payments in the long run. A consistently high payout ratio may indicate that a company is stretching its financial resources or facing financial difficulties that could potentially lead to a dividend cut or suspension. Furthermore, the dividend payout ratio can serve as a tool for comparing companies within the same industry. Investors can evaluate how different companies allocate their earnings and determine which companies have a more favorable dividend policy. Additionally, dividend investors can consider a company's historical payout ratio trends to identify any significant changes that may impact future dividend payments. However, investors should not rely solely on the dividend payout ratio when making investment decisions. It is essential to consider other factors such as the company's overall financial health, cash flow generation, and growth prospects. A comprehensive analysis of a company's financial statements and business strategy is crucial to gain a complete understanding of its dividend-paying potential. In conclusion, the dividend payout ratio is a critical tool for investors in assessing dividend sustainability and understanding a company's approach to distributing earnings. By considering this ratio in conjunction with other financial metrics, investors can make informed decisions when selecting dividend-paying stocks for their portfolio. 2. The power of compounding. 2.1 What is compounding? Compounding is a powerful concept in finance that can significantly enhance your dividend returns over time. It is the process of reinvesting your dividends back into your investment, allowing your investment to grow exponentially. When you reinvest your dividends, you earn returns not only on your initial investment but also on the accumulated dividends. In other words, compounding enables you to earn returns on your returns. To understand how compounding works, let's consider an example. Suppose you invest $10,000 in a dividend-paying stock that has an average annual return of 8%. If you choose to reinvest the dividends, you are taking advantage of compounding. Instead of withdrawing the dividends as cash, you use them to purchase more shares of the same stock. Over time, the number of shares you own increases, and as a result, the amount of dividends you receive also increases. In the first year, let's assume the stock pays a dividend yield of 4%. In this case, you would receive $400 in dividends. By reinvesting this $400, you purchase additional shares of the stock. In the second year, if the stock's price and dividend yield remain the same, your investment would be worth $10,800. Thus, in the second year, you would receive $432 in dividends. By reinvesting these dividends again, you buy more shares and further increase your future dividends. As you continue to reinvest your dividends year after year, the compounding effect accelerates. Over time, your investment grows not linearly but exponentially. Compounding allows you to earn returns not only on your initial investment but also on the accumulated dividends. This compounding effect can significantly boost your dividend returns over the long term. The power of compounding becomes even more apparent when you consider the impact of time. The longer you stay invested and reinvest your dividends, the greater the compounding effect. Over a period of several decades, compounding can turn a modest initial investment into a substantial portfolio. This is why starting early and staying invested for the long term is crucial when capitalizing on the power of compounding. It's important to note that compounding works best when you reinvest your dividends and allow them to compound over time. If you choose to withdraw your dividends as cash instead of reinvesting, you miss out on the potential compounding growth. By reinvesting, you are harnessing the power of compounding and benefiting from the exponential growth of your investment. Compounding is not only limited to dividends but also applies to other types of investments like interest from bonds or capital gains from stocks. However, dividends are particularly suitable for compounding since many dividend-paying companies have a consistent history of raising their dividend payouts over time. In addition to reinvesting dividends, compounding can also be enhanced by adding more funds to your investment regularly. By consistently investing additional funds, you can further accelerate the compounding effect. This approach is often referred to as dollar cost averaging, where you invest a fixed amount at regular intervals, regardless of the market conditions. Dollar cost averaging not only helps to mitigate the impact of market volatility but also maximizes the power of compounding. In summary, compounding is a fundamental concept in finance that can significantly enhance your dividend returns. It involves reinvesting the dividends you receive back into your investment, allowing your investment to grow exponentially over time. The longer you stay invested and reinvest your dividends, the greater the compounding effect. By harnessing the power of compounding, you can unlock the potential for substantial wealth accumulation through your dividend investments. 2.2 The Compound Interest Formula. When it comes to maximizing dividend returns, one of the most powerful concepts to understand is compounding. Compounding allows investors to generate returns not only on their original investment, but also on any reinvested dividends. This can result in exponential growth over time and significantly increase overall returns. The compound interest formula is a fundamental mathematical equation that calculates the future value of an investment with compounding. It shows how the value of an investment grows over time when the earnings or dividends are reinvested, rather than being withdrawn. The formula is as follows. A equals P 1 plus R N caret NT, where A is the future value of the investment, P is the principal investment amount, initial investment, R is the annual interest rate or dividend yield, expressed as a decimal, N is the number of times compounding occurs per year, T is the number of years the money is invested for. Let's break down the components of the formula and understand how they contribute to maximizing dividend returns. Principal investment P. The principal investment P refers to the initial amount of money invested. This is the sum of money that you have dedicated to purchasing dividend-paying stocks or funds. The larger the initial investment, the greater the potential for compounding to have a significant impact on your dividend returns. Annual interest rate or dividend yield R. The annual interest rate or dividend yield R represents the rate of return on your investment. For dividend-paying stocks, this corresponds to the annual percentage of the dividend income relative to the stock price. It is important to note that the interest rate or dividend yield should be expressed as a decimal in the formula. Compounding periods per year N. The compounding periods per year N indicate how often the earnings or dividends are reinvested within a year. It could be quarterly, semi-annually, or annually. The more frequently compounding occurs, the more opportunities there are for reinvesting and generating additional returns. Time of investment T. The time of investment T signifies the number of years the money is invested for. The longer the investment period, the more time there is for compounding to work its magic. This emphasizes the importance of a long-term mindset when it comes to dividend investing. The power of compounding becomes more evident over extended periods. By plugging in the values of these variables into the compound interest formula, investors can determine the future value of their investment after a certain number of years. However, it is essential to note that the formula assumes a constant annual interest rate or dividend yield, which may not always be the case in real-world investing scenarios. The power of compounding dividend returns. The compounding of dividend returns can have a profound impact on an investor's portfolio over time. As dividends are reinvested and contribute to the principal investment, the amount of money generating future returns increases. This results in a snowball effect, where the growth of the investment accelerates as more dividends are reinvested. For example, let's consider an investor who receives $1,000 in dividends annually from their dividend stocks. By reinvesting these dividends at an average annual return of 8% over a 20-year period, the compounding effect can be astonishing. The initial $1,000 investment could grow to over $4,600, showcasing the power of compounding over time. Moreover, the impact of compounding is magnified when the dividends themselves are also growing. Many companies increase their dividends over time, and this growth further enhances the compounding effect. As the dividends increase, the future reinvested amounts become larger, leading to even greater returns in subsequent years. It is crucial for investors to leverage the power of compounding by reinvesting their dividends. Reinvesting allows for the exponential growth of the investment and can lead to substantial increases in overall returns. By continuously reinvesting dividends and allowing the power of compounding to work over an extended period, investors can significantly enhance their dividend returns and achieve their financial goals faster. In conclusion, the compound interest formula provides investors with a powerful tool to understand the impact of compounding on dividend returns. By maximizing the variables within the formula, such as the principal investment, annual interest rate or dividend yield, compounding periods per year, and the time of investment, investors can enhance their returns and take advantage of the exponential growth potential. Reinvesting dividends and maintaining a long-term investment perspective are key strategies for harnessing the power of compounding and achieving financial success through dividend investing. 2.3 Benefits of compounding. Compounding is a powerful concept that can significantly enhance your dividend returns over time. When it comes to investing in dividends, compounding allows you to harness the power of time and reinvested earnings to generate exponential growth in your portfolio. In this section, we will explore the various benefits of compounding and understand why it is a key strategy for maximizing dividend returns. 1. Accelerated growth. One of the main advantages of compounding is its ability to accelerate the growth of your investments. With compounding, not only are you receiving regular dividend payments from your holdings, but you are also reinvesting those dividends to purchase additional shares or securities. As a result, you not only benefit from the initial investment but also from the growth of the reinvested dividends over time. For example, let's say you invested $10,000 in a dividend stock with an annual dividend yield of 4%. In the first year, you would receive $400 in dividends. If you reinvested those dividends and the stock price remained stable, your investment would grow to $10,400. In the second year, you would earn dividends on the increased investment, which would be $416. Over time, this compounding effect can significantly boost your overall returns, especially if you continue to reinvest your dividends over the long term. 2. Increased purchasing power. Another benefit of compounding is the increased purchasing power it provides. By reinvesting your dividends, you are effectively buying more shares or securities at potentially higher prices. As the value of your holdings increases, your dividends grow in proportion, allowing you to buy even more shares in the future. This cycle of reinvestment and growth gradually increases the size of your portfolio, ultimately leading to higher dividend payments. 3. Utilizing time. Time is a crucial aspect of compounding. The longer you allow your investments to compound, the greater the potential for exponential growth. By starting early and consistently reinvesting your dividends, you can harness the power of compounding to build substantial wealth over time. Even small amounts reinvested regularly can make a significant difference in the long run. For instance, let's consider two individuals, Emily and John, both of whom invest $5,000 in dividend stocks. Emily starts investing at the age of 25 and reinvests her dividends, while John begins at 35 and chooses to spend his dividends. Assuming an average annual return of 8% on their investments, by the time they reach the age of 60, Emily's portfolio would be worth significantly more than John's due to the compounding effect. 4. Reducing the impact of market fluctuations. Compounding can help mitigate the impact of market fluctuations on your dividend returns. During periods of market volatility, the reinvested dividends can help offset any potential losses in capital value. By reinvesting dividends when stock prices are low, you are effectively buying more shares at a discounted price, which can lead to greater returns when prices recover. 5. Harnessing the power of compounding interest. Compounding interest is a powerful force that can work in your favor when investing in dividends. As your portfolio grows through the reinvestment of dividends, the compounding effect becomes even more significant. Over time, the dividends you earn on your original investment are reinvested and earn even more dividends, creating a snowball effect of increasing wealth. 6. Long-term wealth accumulation. One of the most significant benefits of compounding is its ability to generate long-term wealth accumulation. By harnessing the power of time and reinvested dividends, you can steadily build wealth and create a reliable income stream that can supplement your regular income or serve as a source of passive income in retirement. The longer you allow your investments to compound, the more substantial your returns are likely to be. In conclusion, compounding is a powerful strategy that amplifies your dividend returns over time. By reinvesting your dividends and allowing them to compound, you can accelerate the growth of your investments, increase your purchasing power, reduce the impact of market fluctuations, and ultimately accumulate substantial wealth. The key is to start early, remain consistent, and have a long-term perspective to fully reap the benefits of compounding in maximizing your dividend returns. 2.4 Time value of money. When it comes to maximizing dividend returns, understanding the concept of time value of money is essential. The time value of money is a fundamental concept in finance that recognizes the idea that money has different values at different points in time. In other words, a dollar received today is worth more than a dollar received in the future. This concept directly impacts the compounding of dividend returns and can significantly influence the growth of your investment portfolio. The basics of the time value of money. At its core, the time value of money considers the principle that an individual would prefer to receive a certain amount of money today rather than the same amount in the future. This preference is influenced by various factors, including inflation, investment opportunities, and the level of risk associated with receiving money at different points in time. The time value of money is based on two key concepts: the future value of money and the present value of money. The future value of money is the value that a given amount of money will have in the future when invested at a certain rate of return. Conversely, the present value of money determines how much a given amount of money will be worth in today's terms. Impact on dividend returns. When it comes to compounding dividend returns, the time value of money plays a crucial role. Dividend payouts received over time can be reinvested to purchase additional shares of stock, effectively increasing the number of shares you own. As a result, the compounding effect occurs. The more time you have to reinvest dividends, the more significant the impact of compounding on your overall returns. Understanding the time value of money helps investors evaluate the potential returns of dividend investments. By assessing the present value of the dividend stream, investors can determine the attractiveness of an investment opportunity. Additionally, it allows investors to compare the potential future value of dividends against alternative investment options. Discounting dividend payments. The time value of money also has implications for discounting dividend payments. Discounting refers to the process of adjusting future cash flows to reflect their present value. By discounting dividends, investors can determine their current worth and compare them to alternative investment opportunities or calculate their present value within a discounted cash flow analysis. Discounting dividends involves applying an appropriate discount rate that reflects the time value of money and the inherent risks associated with the investment. The discount rate helps adjust the future dividend payments to their present value, making it easier to make informed investment decisions. Determining the discount rate. The discount rate used to discount dividend payments is a critical parameter in evaluating the present value of dividends. It typically reflects the opportunity cost of investing in a particular dividend-paying security. In other words, it considers the return that could be earned by investing the same amount of money in an alternative investment with similar risk characteristics. The discount rate incorporates several factors, such as the risk-free rate of return, market risk premium, and specific risks associated with the dividend-paying security. By considering these factors, investors can adequately account for the time value of money and make informed investment decisions. Reinvestment and compounding. The time value of money is closely related to the concept of reinvestment and compounding of dividend returns. As previously mentioned, reinvesting dividends can lead to exponential growth and greater compounding effects over time. By reinvesting dividends received back into the same security or other investment opportunities, you effectively accelerate the accumulation of additional shares, potentially leading to an increase in future dividend payments. Reinvestment and compounding reinforce the importance of the time value of money. Time is a critical factor in maximizing dividend returns. The longer you allow your dividend payments to compound, the greater the potential future value of your investment portfolio. Conclusion. The time value of money is a fundamental concept that has a significant impact on maximizing dividend returns. Understanding the present value of dividend payments, discounting future dividends, and considering the appropriate discount rate are all essential elements for making informed investment decisions. By incorporating the time value of money into your dividend investing strategy, you can effectively harness the power of compounding and achieve your financial goals. 3. Building a dividend portfolio. 3.1 Identifying dividend stocks. Investing in dividend stocks is a popular strategy for those seeking to maximize their returns over the long term. Dividend stocks offer the potential for both capital appreciation and regular income in the form of dividend payments. However, not all dividend stocks are created equal, and it is important to carefully identify the right stocks to include in your dividend portfolio. When it comes to identifying dividend stocks, there are several key factors to consider. Let's explore these factors in detail. Company financials and stability. One of the first steps in identifying dividend stocks is to evaluate the financial health and stability of the company. Look for companies with a history of stable earnings and consistent dividend payments. Ensure that the company has a strong balance sheet, low debt levels, and a sustainable business model. Companies that generate steady cash flow and have a history of increasing dividends are often considered favorable choices. Dividend yield. Dividend yield is an essential metric for identifying dividend stocks. It is calculated by dividing the annual dividend payment by the stock's current price. A higher dividend yield indicates a higher level of income relative to the stock price. However, it is important to note that a high dividend yield alone should not be the sole criteria for selecting a dividend stock. A very high dividend yield could be a sign of an unsustainable dividend or potential financial trouble. It is crucial to balance yield with other factors to ensure the long-term sustainability of dividend payments. Dividend growth. Alongside dividend yield, dividend growth is another key factor to consider when identifying dividend stocks. Companies that consistently increase their dividends over time demonstrate a commitment to returning value to shareholders. Look for companies with a track record of annual dividend increases. Dividend growth is a strong indicator of a company's financial strength, profitability, and overall shareholder-friendly management. Stocks with a history of consistent dividend growth often offer the potential for compounding returns over the long term. Dividend payout ratio. The dividend payout ratio is the percentage of a company's earnings paid out as dividends. It can be a useful metric for assessing the sustainability of dividend payments. Companies with a low payout ratio have a larger portion of earnings to reinvest back into the business, which can support future dividend growth. Conversely, companies with a high payout ratio may struggle to maintain or increase dividend payments in the long run. It is advisable to look for companies with a moderate and sustainable payout ratio. Sector and industry considerations. Diversification is vital when building a dividend portfolio. Consider including dividend stocks from different sectors and industries to spread the risk. Some sectors are known for their stability and consistent dividend payments, such as consumer staples, utilities, and healthcare. However, it is also important to assess the prospects of individual companies within these sectors. Conduct thorough research and analysis to identify industry leaders with sustainable business models and strong competitive advantages. Management and corporate governance. The management team and corporate governance practices of a company play a significant role in its long-term success. Look for companies with competent management teams that have a proven track record of creating value for shareholders. Assess the company's commitment to corporate governance, transparency, and alignment of interests with shareholders. Companies with strong leadership and sound corporate practices are more likely to prioritize the payment of dividends and create long-term shareholder value. Fundamental analysis and research. Conducting thorough fundamental analysis is essential in identifying dividend stocks. Evaluate key financial ratios such as return on equity, ROE, earnings per share, EPS growth, and debt-to-equity ratio. Additionally, review the company's competitive position in the market, its product and service offerings, and its growth prospects. Utilize research reports, financial websites, and reputable sources to gather information and make informed investment decisions. Market conditions and valuation. Consider the prevailing market conditions and the valuation of dividend stocks before making investment decisions. Market volatility and economic cycles can impact the performance of dividend stocks. Evaluate whether the stock is undervalued, overvalued, or appropriately priced based on factors such as price-to-earnings P/E ratio, price-to-book P/B ratio, and dividend discount models. Taking into account the market conditions and the valuation of dividend stocks can help optimize the risk-return profile of your dividend portfolio. In conclusion, identifying dividend stocks requires careful consideration of several key factors, including company financials and stability, dividend yield and growth, dividend payout ratio, sector and industry considerations, management quality, fundamental analysis, and market conditions and valuation. A well-researched and diversified dividend portfolio can help maximize dividend returns and provide a steady income stream over the long term. 3.2 Evaluating dividend growth. Evaluating the growth potential of dividends is a crucial aspect of building a successful dividend portfolio. Dividend growth is the rate at which a company's dividends increase over time. By identifying and investing in companies with a history of consistent and robust dividend growth, investors can maximize their dividend returns and enhance the long-term growth of their portfolio. Understanding dividend growth. Dividend growth is an indicator of a company's financial strength and stability. A company that consistently increases its dividends demonstrates a commitment to returning profits to shareholders and signifies a healthy and profitable business model. Dividend growth is driven by several factors, including increasing earnings, improving cash flow, and a positive outlook for the company's future prospects. To evaluate dividend growth, investors can examine a company's dividend history over a significant period, typically spanning several years. By analyzing the annual dividend payments, investors can determine the average annual growth rate of dividends. A consistent pattern of increasing dividends indicates that the company has a strong financial position and is able to sustain and grow its dividend payments over time. Key metrics for evaluating dividend growth. When evaluating dividend growth, investors can utilize key metrics to assess the financial health and potential of a company. Some of the essential metrics for evaluating dividend growth include dividend growth rate (DGR). The dividend growth rate measures the annual percentage increase in dividend payments. It provides a clear picture of how fast a company is increasing its dividend payouts. Investors typically look for companies with a high dividend growth rate, as it indicates strong financial performance and potential for future dividend increases. Dividend payout ratio (DPR). The dividend payout ratio is the percentage of a company's earnings that it distributes as dividends to shareholders. A low dividend payout ratio indicates that the company retains a significant portion of its earnings for reinvestment or future growth, leaving room for potential dividend increases. On the other hand, a high dividend payout ratio may signal that the company is using a substantial portion of its earnings to pay dividends and may have limited room for further increases. Free cash flow (FCF). Free cash flow is another critical metric for evaluating dividend growth. It represents the amount of cash generated by a company's operations after deducting operating expenses and capital expenditures. Positive free cash flow enables a company to fund dividend payments and pursue growth opportunities, making it crucial for sustaining and increasing dividends over time. Earnings per share (EPS) growth. Earnings per share growth is an indicator of a company's profitability and financial performance. It measures the rate at which a company's earnings per share increase over time. A company with consistently growing earnings per share is more likely to have the financial capacity to increase its dividend payments. Researching dividend growth companies. Identifying companies with a track record of consistent and substantial dividend growth requires thorough research and analysis. Investors can use various resources to gather information and evaluate the dividend growth potential of different companies. Here are a few key steps to consider. Company financial statements. Analyzing a company's financial statements, including income statements, balance sheets, and cash flow statements, can provide valuable insights into its financial health. Investors should pay close attention to the company's dividend history, earnings, growth, and cash flow trends. Dividend growth history. Reviewing a company's dividend history is essential to evaluate its track record of increasing dividend payments. Investors can examine the annual dividend growth rate over the past 5 to 10 years, looking for consistency and stability in dividend growth. Industry analysis. Assessing the industry in which a company operates can give investors an understanding of its growth potential. Analyzing industry trends, competitive landscape, and economic conditions can help determine whether a company is well positioned to sustain and grow its dividends. Analyst reports and recommendations. Research reports and recommendations from reputable analysts can provide valuable insights into the dividend growth potential of specific companies. These reports often include detailed analysis of a company's financials, future outlook, and dividend growth projections. Considerations for evaluating dividend growth. While evaluating dividend growth, it is crucial to consider a few factors that could impact a company's ability to sustain and increase its dividends. Economic environment. The overall economic environment can significantly influence a company's dividend growth prospects. During economic downturns or periods of financial instability, companies may face challenges in maintaining dividend growth. Therefore, it is essential to assess the economic conditions and their potential impact on dividend-paying companies. Company's industry and competitive position. The industry dynamics and the competitive landscape in which a company operates can impact its dividend growth potential. Companies in mature and stable industries may have slower dividend growth rates compared to those in high-growth sectors. It is important to evaluate the competitive position and potential growth opportunities for companies under consideration. Management track record and strategy. Assessing the management team's track record and their commitment to delivering shareholder value is crucial. A strong management team with a clear strategy for growth and a history of prudent capital allocation decisions is likely to prioritize dividend growth. Conclusion. Evaluating dividend growth, along with other key metrics, is essential for constructing a dividend portfolio focused on maximizing returns. By identifying companies with a history of consistent and robust dividend growth, investors can enhance the potential for long-term capital appreciation and income generation. Thorough research, analysis of financial statements, and considerations of economic and industry factors are essential in evaluating dividend growth potential and building a successful dividend portfolio. 3.3 Diversification. Diversification is a critical aspect of building and maintaining a successful dividend portfolio. It involves spreading your investments across different asset classes, sectors, industries, and geographic regions to reduce the risk associated with individual stocks and increase the potential for consistent dividend returns. Why diversification matters. Diversification is an essential risk management strategy that aims to minimize the impact of any single investment on your overall portfolio. By diversifying your holdings, you can reduce the potential losses from a single investment that may underperform or face unexpected challenges. It helps you to spread out the risk and avoid putting all your eggs in one basket. In the context of dividend investing, diversification is crucial because it allows you to access a wide range of dividend-paying companies. It ensures that even if one or a few companies experience a dividend cut or suspension, your overall dividend income will not be significantly affected. Furthermore, diversification helps you capture the opportunities presented by different sectors and regions. By investing in various industries and geographical areas, you can potentially benefit from economic growth and stability in different parts of the world. This can help you weather downturns in specific sectors or regions, as other sectors or regions may continue to perform well. How to diversify your dividend portfolio. Here are some key strategies to consider when diversifying your dividend portfolio. 1. Asset class diversification. Diversify your holdings across different asset classes to reduce exposure to any single type of investment. Alongside dividend stocks, consider adding bonds, real estate investment trusts, REITs, and other income-generating assets to your portfolio. Bonds can provide stability and consistent income, while REITs offer exposure to the real estate market. 2. Sector diversification. Investing in a wide range of sectors spreads your risk across different industries. Rather than focusing solely on one sector, such as technology or finance, consider diversifying across sectors like consumer goods, healthcare, utilities, energy, and others. This approach provides exposure to various areas of the economy and reduces the impact of sector-specific risks. 3. Geographic diversification. Expand your portfolio beyond your home country to benefit from global opportunities and reduce the impact of local economic factors. Investing in international markets and companies can provide exposure to different currencies, regulations, and economic cycles. Consider allocating a portion of your portfolio to companies based in different regions, such as Europe, Asia, or emerging markets. 4. Company size diversification. Diversify your holdings across companies of different sizes, including large cap, mid cap, and small cap stocks. Large cap companies typically offer stability and consistent dividends, while small cap stocks may provide higher growth potential. By diversifying across companies of different sizes, you can balance risk and return and potentially capture the benefits of both stability and growth. 5. Dividend growth versus high yield. Strike a balance between dividend growth and high yield stocks. Dividend growth stocks typically have a track record of increasing dividends over time, while high yield stocks may offer higher initial yields but might not have the same growth prospects. Combining both types of stocks in your portfolio can provide both income and potential for future dividend increases. 6. Reinvestment options. Consider diversifying your reinvestment options by utilizing different dividend reinvestment vehicles. Explore direct stock purchase plans, DSPPs, exchange-traded funds, ETFs, and dividend-focused mutual funds. Each of these options provides an opportunity to reinvest your dividends and potentially gain exposure to additional dividend-paying companies. Assessing diversification. To evaluate the level of diversification in your dividend portfolio, consider the following aspects. 1. Number of holdings. The number of individual investments in your portfolio can provide an initial indication of diversification. While there is no specific threshold, having a reasonable number of holdings can help spread the risk effectively. 2. Correlation analysis. Conduct a correlation analysis to understand how closely your holdings move together. Lower correlations indicate a higher level of diversification. Aim to have a mix of investments that don't move in sync with each other to reduce the impact of market fluctuations on your portfolio. 3. Risk-return analysis. Evaluate the risk-return profile of your portfolio. Understand the potential risks associated with each investment and how they might impact your overall portfolio. Balancing higher risk investments with more stable options can help manage risk and optimize returns. 4. Regular portfolio review. Regularly review and rebalance your dividend portfolio to ensure it remains diversified. Market conditions, economic factors, and company performance can change over time. By staying informed and making necessary adjustments, you can maintain an appropriate level of diversification. Conclusion. Diversification is a crucial component of building and managing a dividend portfolio. It helps spread risk, increase potential returns, and provide stability in different market conditions. By diversifying across asset classes, sectors, regions, company sizes, and investment types, you can reduce the impact of any single investment and position yourself for consistent dividend returns. Regularly assess and adjust your portfolio to ensure its diversification remains aligned with your investment goals and risk tolerance. 3.4 Risk management. While maximizing dividend returns is an important goal for any investor, it is equally important to manage the associated risks. Risk management strategies play a crucial role in safeguarding your investment portfolio and ensuring long-term sustainability. In this section, we will explore various risk management techniques that can help you navigate the potential pitfalls of dividend investing. Diversification. One of the key risk management strategies in dividend investing is diversification. Diversifying your portfolio involves spreading your investments across different companies and industries to reduce the impact of any individual stock's performance on your overall returns. By investing in a variety of dividend stocks across sectors such as technology, healthcare, finance, and consumer goods, you can minimize the risk of loss associated with any single company or industry. Diversification helps to spread out the risks and provides a buffer against unexpected downturns in specific sectors. Additionally, diversification can also help you manage the impact of dividend cuts or suspensions. When you hold a diversified portfolio, the negative impact of one company's decision to reduce or eliminate its dividend payout is mitigated by the positive performance of other dividend-paying stocks in your portfolio. Evaluating dividend sustainability. Another element of risk management in dividend investing is evaluating the sustainability of dividends. It is important to assess whether a company can consistently generate enough earnings to support its dividend payments over the long term. Analyzing a company's financial health, profitability, cash flow, and dividend payout ratio can provide insights into its ability to sustain and grow dividends. Companies with a long track record of steadily increasing dividends may offer more stability and lower risk compared to companies that have a history of erratic dividend payments. Furthermore, monitoring key financial indicators and conducting thorough fundamental analysis can help identify warning signs of potential dividend cuts or suspensions. Factors such as high debt levels, declining revenues, or weakening industry trends should be considered red flags that warrant further investigation. Understanding market conditions. Another important aspect of risk management in dividend investing is understanding and navigating market conditions. Dividend stocks can be influenced by various economic and market factors, and it is crucial to adapt your investment strategy to prevailing conditions. During periods of economic uncertainty or market volatility, companies may face challenges in generating consistent and reliable earnings. In such conditions, it becomes even more critical to evaluate the sustainability of dividend payments and the overall financial health of the companies in your portfolio. Moreover, dividend investors should also consider the impact of interest rates and inflation on their investments. Changes in interest rates can influence the attractiveness of dividend stocks relative to other investment options. Additionally, high inflation rates can erode the purchasing power of dividend income if it does not keep pace with rising prices. By staying informed about macroeconomic trends, market conditions, and central bank policies, you can better position yourself to manage potential risks and adjust your dividend portfolio accordingly. Setting realistic expectations. Risk management also involves setting realistic expectations for your dividend returns. While dividend investing can provide a steady income stream and potential capital appreciation, it is important to understand that returns may not be consistent or guaranteed. Companies may choose to adjust their dividend policies based on their financial performance, market conditions, or strategic priorities. Dividends can be increased, decreased, or suspended altogether, depending on various factors. Keeping a long-term perspective and understanding that short-term fluctuations and temporary setbacks are part of the investing journey can help manage expectations and mitigate the emotional impact of market downturns. Implementing stop-loss orders. Stop-loss orders can be a valuable risk management tool for dividend investors. A stop-loss order is an instruction to sell a stock when its price falls to a predetermined level. By placing a stop-loss order on your dividend stocks, you can limit potential losses and protect your investment capital. When setting a stop-loss order, it is important to consider the individual stock's volatility and your risk tolerance. Setting the stop-loss order too tight may result in unnecessary selling of stocks during normal price fluctuations, while setting it too wide may expose you to higher potential losses. By combining stop-loss orders with regular portfolio monitoring and analysis, you can proactively manage the risk of holding dividend stocks that may be underperforming or facing fundamental challenges. Conclusion. Risk management is an integral part of maximizing dividend returns and safeguarding your investment portfolio. Diversification, evaluating dividend sustainability, understanding market conditions, setting realistic expectations, implementing stop-loss orders, and continuous portfolio monitoring all contribute to effective risk management in dividend investing. A well-rounded dividend investment strategy not only focuses on maximizing returns but also on mitigating potential risks. By adopting these risk management techniques, you can enhance the stability and long-term sustainability of your dividend portfolio and ultimately achieve your financial goals. Remember, successful investing requires a balance of risk and reward, and risk management is the key to finding that balance. 4. Reinvesting dividends. 4.1 Importance of reinvesting dividends. One of the most powerful strategies for maximizing dividend returns is the practice of reinvesting dividends. When a company distributes dividends to its shareholders, investors have the option to receive these dividends in the form of cash or reinvest them back into the company by purchasing additional shares. Reinvesting dividends allows investors to take advantage of the power of compounding, which can significantly enhance long-term investment returns. The concept of compounding. Compounding is a fundamental principle in finance that involves reinvesting earnings and generating additional returns on those reinvested earnings. It is often described as a snowball effect, or interest on interest. When dividends are reinvested, the investor benefits from the compounding effect, as the reinvested dividends generate additional dividends in the future. Over time, this compounding can lead to exponential growth of investment returns. Accelerated growth of investment. By reinvesting dividends, investors can accelerate the growth of their investment portfolios. Let's consider an example to understand the power of compounding dividends. Suppose an investor holds a $10,000 investment in a dividend-paying stock that has an annual dividend yield of 4%. If the investor chooses to reinvest the dividends, the additional shares purchased will also receive dividends in the following periods. Over time, the compounded effect of the reinvested dividends can generate substantial returns. Long-term impact. The long-term impact of reinvesting dividends is significant. Historical data demonstrates that a significant portion of the total returns in the stock market is generated through dividend income. By reinvesting dividends, investors can potentially enhance their total return on investment and accumulate greater wealth over time. The longer the compounding period, the more pronounced the impact becomes. Dollar cost averaging. Reinvesting dividends also incorporates the concept of dollar cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of the share price. When dividends are reinvested, the investor automatically purchases more shares when the market price is down, and fewer shares when the price is up. This consistent investment approach can help mitigate the impact of market volatility and reduce the average cost per share over time. Increasing dividend income. Another advantage of reinvesting dividends is the potential for increasing dividend income over time. As companies increase their dividend payouts, reinvesting the dividends allows investors to accumulate more shares, which in turn results in higher dividend income in the future. This can create a compounding effect not only on the investment returns but also on the steady stream of income generated through dividends. Reinvesting versus cash dividends. While receiving cash dividends may seem appealing, especially for investors seeking immediate income, reinvesting dividends offers distinct benefits. Reinvesting dividends allows for the potential compounding of returns, leading to significant long-term growth. On the other hand, receiving cash dividends may result in missed opportunities for investors to harness the full potential of their investments. By immediately reinvesting dividends, investors actively participate in the growth potential of the underlying assets. Tax advantages. Reinvesting dividends can also have tax advantages. When dividends are reinvested, they are treated as if they were cash dividends received and then used to purchase additional shares. However, taxes on the reinvested dividends are not due until the investor sells the shares. This deferral of taxes allows the investor to potentially benefit from a more favorable tax treatment, which can enhance overall returns. Considerations for reinvesting dividends. While reinvesting dividends can be a powerful strategy, there are a few important considerations for investors to keep in mind. Dividend growth. It's essential to invest in companies that have a history of consistently increasing their dividends. Reinvesting in companies with sustainable dividend growth can lead to higher future returns. Diversification. It is important to diversify the dividend portfolio by reinvesting in multiple dividend-paying stocks across different sectors and industries. This can help mitigate the risks associated with individual companies or sectors. Rebalancing. Regularly review and rebalance the portfolio to ensure that the allocation still aligns with the investment objectives and risk tolerance. Rebalancing can help maintain the desired asset mix and potentially improve the risk-adjusted returns. Patience and discipline. Successful dividend reinvestment requires patience and discipline. It is crucial not to be swayed by short-term market fluctuations and maintain a long-term investment perspective. In conclusion, reinvesting dividends can be a potent strategy for maximizing dividend returns. By harnessing the power of compounding, investors can accelerate the growth of their investment portfolios, benefit from dollar cost averaging, increase dividend income, and potentially enjoy tax advantages. It is essential to carefully consider the benefits and implement this strategy as part of a well-diversified and long-term investment plan. 4.2 Dividend Reinvestment Plans (DRIPs). Dividend reinvestment plans (DRIPs) are a popular method of maximizing dividend returns and compounding wealth over time. A DRIP is an investment strategy that allows shareholders to automatically reinvest their dividend income back into acquiring additional shares or fractions of shares of the dividend-paying stock. By reinvesting dividends, investors can take advantage of the power of compounding, which can significantly enhance long-term wealth accumulation. How DRIPs work. DRIPs provide shareholders with the option to reinvest their dividends in the issuing company at little or no cost. When dividends are paid, instead of receiving a cash payout, the dividend income is automatically used to purchase additional shares of the same company. Let's consider an example to better understand how DRIPs work. Suppose you own 100 shares of XYZ company, and the quarterly dividend per share is $1. Through a DRIP, instead of receiving $100 as cash dividends, your dividend income of $100 will be reinvested in buying additional shares of XYZ company. Depending on the current share price, you would receive an additional 2.5 shares, assuming a share price of $40 through the DRIP. As a result, you would then own 102.5 shares. Over time, as you continue to reinvest your dividends through a DRIP, the number of shares you own will keep increasing. As the number of shares grows, so will your future dividend payments since you will receive dividends on the increased number of shares. This compounding effect accelerates the growth of your investment and can lead to substantial wealth accumulation over the long term. Benefits of DRIPs. DRIPs offer several advantages to investors looking to maximize their dividend returns. 1. Compounding wealth. By reinvesting dividends, the power of compounding takes effect, allowing your investment to grow exponentially over time. As your investment continues to compound, the growth rate increases because the dividends earned on the reinvested dividends further contribute to the compounding process. Over the long term, this compounding effect can lead to significant wealth accumulation. 2. Cost efficiency. DRIPs typically have minimal or no transaction costs or fees associated with reinvesting dividends. This cost-effective nature makes them an attractive option for investors looking to reinvest their dividends without incurring extra expenses. By avoiding transaction fees, a larger portion of your dividends can be reinvested, further maximizing your returns. 3. Dollar cost averaging. Through DRIPs, investors automatically buy additional shares of a stock at regular intervals, usually when dividends are paid. This investment technique, known as dollar cost averaging, helps investors mitigate the impact of market fluctuations. When share prices are high, the dividend income will buy fewer shares, and when share prices are low, the dividend income will buy more shares. This strategy allows investors to benefit from the market's natural volatility and potentially accumulate a larger number of shares at lower average prices. 4. Long-term focus. DRIPs are particularly beneficial for long-term investors who have a time horizon of several years or more. By continuously reinvesting dividends, investors stay committed to the long-term growth of their investments, disregarding short-term market fluctuations. This approach helps build wealth steadily over time and allows investors to take advantage of the power of compounding. Considerations for DRIPs. While DRIPs offer numerous benefits, there are a few things to keep in mind when considering this investment strategy. 1. Tax implications. Reinvesting dividends through DRIPs may still be subject to taxation, even though the income is not received as cash. Each reinvested dividend is considered a taxable event, as it is treated as if you receive the dividend in cash and then use that cash to purchase additional shares. Therefore, it's important to be aware of the potential tax implications and consult with a tax advisor for guidance. 2. Portfolio diversification. When using DRIPs, investors should be cautious not to overconcentrate their portfolio in a single stock or industry. Diversification is essential to manage risk effectively. It's advisable to consider a mix of different dividend-paying stocks to ensure a well-balanced and diversified portfolio. 3. Regular evaluation. Investors need to regularly monitor and reassess their DRIP investments. While DRIPs are typically a long-term investment strategy, it's important to periodically review the performance of the underlying stocks and make informed decisions accordingly. Evaluating the company's financial health, dividend sustainability, and market conditions will help ensure that the DRIP investments align with your investment objectives. In conclusion, DRIPs are an effective way to maximize dividend returns and harness the power of compounding. By reinvesting dividends into additional shares of a dividend-paying stock, investors can benefit from the compounding effect, potentially leading to significant wealth accumulation over time. However, it's crucial to consider the tax implications, maintain a diversified portfolio, and regularly review and evaluate DRIP investments to align with your financial goals. 4.3 Tax implications of reinvesting dividends. Reinvesting dividends can be a powerful strategy for maximizing your investment returns in the long run. However, it is important to understand the tax implications associated with this approach. While reinvested dividends can generate significant growth over time, they may also have potential tax consequences that investors should be aware of. Dividend taxation basics. Dividends are typically subject to taxation, as they are considered income generated from your investments. The tax treatment of dividends varies depending on the type of dividend and the investor's tax situation. It is crucial to understand how dividends are classified for tax purposes to effectively manage your tax obligations. Qualified versus non-qualified dividends. Dividends can be classified as either qualified or non-qualified, and the tax rates applied to each of these categories differ. Qualified dividends are subject to a lower tax rate, similar to long-term capital gains rates. On the other hand, non-qualified dividends are taxed at the individual's ordinary income tax rate. To qualify for the lower tax rate on dividends, certain criteria must be met. The most common requirement is that the stock must be held for a specific period, known as the holding period. In general, the holding period for common stocks is more than 60 days during the 121-day period that starts 60 days before the ex-dividend date. However, it is essential to consult with a tax professional or refer to the Internal Revenue Service (IRS) guidelines for specific holding period requirements and eligibility criteria. Tax treatment of reinvested dividends. When you reinvest your dividends, they are typically used to purchase additional shares of the dividend-paying stock or fund. While this reinvestment can help compound your returns over time, it does not alter the tax implications of the dividends themselves. Reinvested dividends are still subject to taxation based on their classification as qualified or non-qualified dividends. It's important to understand that even though you haven't received the dividends in cash, they are still treated as taxable income. As a result, your tax liability can increase, even if you choose to reinvest the dividends rather than receive them as cash. You should consult with a tax advisor or use tax software to calculate your tax obligations accurately. Tax withholding and reporting. Another important factor to consider when reinvesting dividends is the impact of tax withholding and reporting. When dividends are distributed, the paying entity may withhold a portion of the dividend payment for tax purposes. This withholding is typically performed even if you choose to reinvest the dividends. It is crucial to review your investment account's tax reporting and ensure that proper documentation is provided to accurately report your dividend income. Most brokerage firms and financial institutions will provide a Form 1099 DIV to report the dividends paid to you during the tax year. This document outlines the amount and classification of the dividends received, making it easier to report and calculate your tax liability. Tax-efficient dividend investing strategies. Although reinvesting dividends can have tax implications, there are strategies you can employ to minimize your tax burden and make your dividend investing more tax-efficient. Here are a few approaches to consider. Tax-advantaged accounts. Utilize tax-advantaged accounts like individual retirement accounts, IRAs, or Roth IRAs to hold your dividend-paying investments. These accounts offer tax benefits that can help mitigate the tax impact of dividend income. Invest in municipal bonds. Consider adding municipal bonds to your portfolio as they provide tax-free interest income. Municipal bond funds or individual bonds issued by state and local governments can offer a way to generate income without incurring federal income taxes. Focus on qualified dividends. If possible, concentrate on investing in companies that consistently pay qualified dividends. This strategy can result in lower tax rates on your dividend income while still allowing you to benefit from compounding growth. Tax loss harvesting. Take advantage of tax loss harvesting by selling securities that have declined in value to offset capital gains. This technique can help reduce your taxable income from dividends and other investments. Strategic asset location. Optimize your investment allocation across different types of accounts to take advantage of tax-efficient asset location. For example, consider holding tax-inefficient investments like bond funds in tax-advantaged accounts and dividend-focused stocks in taxable brokerage accounts. Remember, tax laws can change, and individual circumstances vary, so it is crucial to consult a tax professional or financial advisor to determine the best tax-efficient strategies that align with your specific situation. Conclusion. Reinvesting dividends can be an effective strategy for maximizing your long-term investment returns. However, it is essential to understand the tax implications associated with reinvesting dividends. By understanding the tax treatment of dividends, classifying them as qualified or non-qualified, and employing tax-efficient strategies, you can minimize your tax burden and optimize the growth potential of your dividend portfolio. Always consult with a tax advisor or professional to ensure that you are making informed decisions and complying with current tax regulations. 4.4 Strategies for Reinvesting Dividends. Reinvesting dividends is a smart strategy for maximizing your investment returns and achieving the power of compounding. By reinvesting the dividends you receive from your investments, you have the opportunity to accelerate your wealth growth and generate even higher future dividend income. In this section, we will explore some effective strategies for reinvesting dividends and making the most of the compounding effect. Reinvesting dividends, the basics. Before diving into the strategies, let's review the basics of reinvesting dividends. When you own a dividend-paying stock or fund, you have the option to reinvest the dividends, rather than taking them as cash payments. Reinvesting dividends means using the dividend income to purchase additional shares of the same stock or fund. Dividend reinvestment plans, DRIPs. One popular strategy for reinvesting dividends is utilizing dividend reinvestment plans, commonly known as DRIPs. DRIPs allow you to automatically reinvest your dividends back into the same stock or fund without incurring any transaction fees. Many companies offer DRIPs directly to their shareholders, while some brokerage firms also provide this feature. The advantage of DRIPs is that they facilitate the compounding process by reinvesting your dividends immediately. As a result, your ownership in the company or fund increases over time, and so does the amount of future dividends you receive. DRIPs also often offer the option to purchase shares at a discounted price, further enhancing your overall returns. Partial dividend reinvestment. Another strategy for reinvesting dividends is to opt for partial dividend reinvestment. Instead of reinvesting the entire dividend payment, you can choose to reinvest only a portion of it and keep the rest as cash. This strategy gives you some flexibility to use the cash for other purposes or in case you need to access the funds in the short term. Partial dividend reinvestment allows you to balance reinvesting for long-term growth with maintaining some liquidity. It can be particularly useful if you are nearing retirement or have specific financial goals that require access to cash in the near future. By selectively reinvesting dividends, you can align your investment strategy with your individual needs and circumstances. Timing dividend reinvestment. Timing is an essential factor to consider when reinvesting dividends. Since dividends are typically paid on specific dates, you must decide when to reinvest the dividends you receive. There are two main approaches to timing dividend reinvestment: regular interval investing and opportunistic investing. Regular interval investing involves reinvesting dividends at predetermined intervals, such as monthly, quarterly, or annually. This strategy provides a disciplined approach and helps you take advantage of dollar cost averaging. By reinvesting dividends consistently over time, you can reduce the impact of short-term market fluctuations and potentially benefit from buying more shares when prices are lower. On the other hand, opportunistic investing involves monitoring market conditions and reinvesting dividends when you believe it is the most advantageous time. This strategy requires more active involvement and an understanding of market trends. By reinvesting dividends when stock prices are low or during market downturns, you can potentially acquire shares at a discounted price and increase your future dividend income. Allocation of reinvested dividends. Deciding how to allocate your reinvested dividends is another important consideration. One strategy is to reinvest dividends proportionally across your existing holdings. This approach ensures that your investment portfolio maintains a balanced distribution according to your initial investment allocation. Alternatively, you may choose to selectively reinvest dividends into specific stocks or funds that you believe offer better growth prospects or higher dividend yields. By focusing on such investments, you can potentially optimize the compounding effect and enhance your overall returns. Tax-efficient dividend reinvestment. Tax efficiency is crucial when reinvesting dividends. Depending on your tax jurisdiction and the types of accounts you hold, such as taxable accounts or tax-advantaged retirement accounts, the tax implications of reinvesting dividends can vary. It is important to understand the tax consequences and utilize tax-efficient strategies to maximize your after-tax returns. Tax-efficient dividend reinvestment strategies may include holding dividend-paying stocks in tax-advantaged accounts like individual retirement accounts (IRAs), or using tax-efficient investment vehicles, such as exchange-traded funds (ETFs). Additionally, reinvesting dividends in stocks or funds that qualify for favorable tax treatment, such as qualified dividends, can further optimize your tax situation. Conclusion. Reinvesting dividends is a potent strategy for compounding your investment returns. By adopting effective reinvestment strategies such as utilizing DRIPs, partially reinvesting dividends, timing dividend reinvestment, allocating reinvested dividends, and optimizing tax efficiency, you can enhance the power of compounding and achieve greater long-term wealth accumulation. Remember to align your reinvestment strategy with your financial goals and continually monitor and adjust your portfolio to ensure it remains aligned with your objectives. 5. Dividend growth investing. 5.1 Benefits of dividend growth stocks. Dividend growth stocks offer numerous benefits to investors looking to maximize their dividend returns. These stocks are companies that consistently increase their dividend payments to shareholders over time. By investing in dividend growth stocks, you can take advantage of the power of compounding to enhance your overall investment returns. In this section, we will explore the key benefits of dividend growth stocks and why they should be an essential component of your investment portfolio. Building wealth through increasing dividends. One of the primary advantages of dividend growth stocks is the potential to build significant wealth over the long term. Unlike fixed income investments, where the income remains constant, dividend growth stocks provide the opportunity for your dividend income to increase over time. This compounding effect allows you to reinvest higher dividend payments into additional shares, thus increasing your ownership in the company. Consequently, your future dividend payments are based on a larger number of shares, leading to a higher stream of income. Reliable and consistent income. Dividend growth stocks are typically more stable and reliable compared to non-dividend paying or low dividend paying stocks. Companies that consistently increase their dividends tend to be financially healthy and have strong cash flows. By investing in these companies, you can enjoy a reliable and consistent income stream that can be particularly beneficial during economic downturns or periods of market volatility. The regular dividend payments provide a source of income that can be used to cover living expenses, reinvested, or simply contribute to your overall financial well-being. Long-term capital appreciation. In addition to the income generated through dividends, dividend growth stocks also offer the potential for long-term capital appreciation. Companies that consistently increase their dividends are often well-managed, financially sound, and have a track record of strong performance. As these companies continue to grow and expand their operations, their stock prices can appreciate, providing you with capital gains on top of your dividend income. Inflation protection. Dividend growth stocks can act as a hedge against inflation. Unlike fixed income investments, where the income is fixed and may not keep pace with inflation, dividend growth stocks have the potential to increase their dividend payments over time. As the cost of living rises, companies that increase their dividends can help protect your purchasing power. By investing in dividend growth stocks, you can ensure that your income keeps up with or even surpasses inflation, helping you maintain your standard of living over the long term. Lower volatility and reduced risk. Dividend growth stocks tend to exhibit lower volatility compared to non-dividend paying stocks. The consistent cash flow from dividends provides a cushion during market downturns, helping to reduce the overall risk of your investment portfolio. Additionally, companies that consistently increase their dividends are often more resilient and less prone to severe stock price declines during turbulent market conditions. By investing in dividend growth stocks, you can potentially achieve a smoother investment journey with lower downside risk. Reinvestment and compound growth. Dividend growth stocks offer investors the advantage of reinvesting their dividends to compound their returns. When you reinvest your dividends through a dividend reinvestment plan, DRIP, or by manually purchasing additional shares, you can increase the number of shares you own. Over time, this compounding effect can significantly enhance your investment returns. By reinvesting your dividends, you take advantage of the power of compounding and accelerate the growth of your investment portfolio. Tax advantages. Dividend growth stocks can also provide certain tax advantages. In many countries, dividends are often taxed at a lower rate than interest income. This favorable tax treatment can result in higher after-tax returns for investors. Additionally, qualified dividends may be subject to preferential tax rates, further enhancing the tax efficiency of investing in dividend growth stocks. Consult with a tax professional or financial advisor to understand the specific tax implications and benefits based on your individual circumstances and tax laws in your country. Long-term stability and peace of mind. Investing in dividend growth stocks offers a sense of stability and peace of mind for many investors. The consistent dividend payments and the potential for increasing dividends provide reassurance that the company is performing well and generating sufficient cash flow. This stability can help investors weather market fluctuations and instill confidence in their long-term investment strategy. Dividend growth stocks are often considered less speculative and more suitable for conservative investors seeking a reliable income stream. In conclusion, dividend growth stocks offer numerous benefits to investors seeking to maximize their dividend returns. Through compounding, reliable income, potential capital appreciation, inflation protection, lower volatility, reinvestment opportunities, tax advantages, and long-term stability, dividend growth stocks can serve as a valuable component of your investment portfolio. By carefully selecting and diversifying your holdings in dividend growth stocks, you can take advantage of the power of compounding and enjoy the benefits provided by these high-quality, income-generating companies. 5.2 Dividend Aristocrats and Dividend Kings. One of the key strategies in building a dividend growth portfolio is to invest in companies that have a proven track record of consistently increasing their dividends over time. Two groups of companies that often fit this criterion are dividend aristocrats and dividend kings. This section will explore what these terms mean and why they are important for dividend investors. Dividend aristocrats. Dividend aristocrats are a distinguished group of companies that have increased their dividend payouts for at least 25 consecutive years. These companies are recognized and tracked by S&P Dow Jones Indices, which maintains an index named the S&P 500 Dividend Aristocrats. To be included in this index, a company must be a member of the S&P 500 and meet the dividend growth criteria. The dividend aristocrats are often sought after by investors because they demonstrate a commitment to returning value to shareholders and have a history of weathering various economic cycles. These companies have proven their ability to generate consistent and growing cash flows, which allows them to reward their shareholders with regular dividend increases. Investing in dividend aristocrats can offer several advantages. Firstly, these companies tend to be well established and have a strong competitive advantage in their respective industries. They often have a track record of stable earnings and consistent dividend growth, which can provide investors with a sense of stability and reliability. Secondly, dividend aristocrats have demonstrated their ability to adapt and thrive in various market conditions. Companies that can consistently raise their dividends for many years have shown their resilience in difficult times. This can provide investors with confidence that these companies can navigate economic downturns and continue to generate stable income even during challenging periods. Lastly, dividend aristocrats are often seen as quality investments due to their long history of dividend growth. Their ability to consistently increase dividends indicates that they are well managed and have a shareholder-friendly approach. These companies generally have strong cash flow generation, which allows them to reinvest in their businesses while still rewarding their shareholders with growing dividends. It is important to note that not all dividend aristocrats are created equal. Some companies within this group may have higher dividend yields, while others may have lower yields but higher dividend growth rates. Investors should consider their individual investment goals and risk tolerance when selecting specific dividend aristocrats for their portfolio. Dividend Kings. Dividend Kings are an even more exclusive group of companies that have raised their dividends for at least 50 consecutive years. Achieving 50 years of uninterrupted dividend growth is a significant accomplishment and showcases exceptional stability and consistency. These companies have demonstrated an ability to generate substantial cash flows and sustain dividend increases over several decades. The number of dividend kings is considerably smaller than that of dividend aristocrats. As of the time of writing, there are only around 30 dividend kings. These companies have shown a remarkable dedication to returning value to their shareholders and have proven themselves as resilient performers. Investing in dividend kings can offer investors several advantages. They provide an extra layer of assurance and stability due to their long history of dividend increases. These companies have managed to navigate through numerous economic cycles, including recessions and market downturns, while still maintaining their dividend growth streaks. Dividend kings are also often well-established companies with a strong market position and competitive advantage. This stability and consistency can provide investors with peace of mind and a sense of security in their investment. Moreover, these companies are typically known for their ability to generate steady and predictable cash flows, which is instrumental in sustaining their dividend growth streaks. Similar to dividend aristocrats, dividend kings may have varying dividend yields and growth rates. They are not immune to challenges and changes in the business environment. Therefore, it is crucial for investors to conduct thorough research into the financial health and long-term prospects of these companies before making investment decisions. Importance of dividend aristocrats and dividend kings. Both dividend aristocrats and dividend kings are highly regarded among dividend investors for their consistent and growing dividends. Investing in these companies can offer stability, reliability, and the opportunity for long-term wealth accumulation through dividend compounding. Dividend aristocrats and dividend kings can serve as a solid foundation for a dividend growth portfolio. While past performance does not guarantee future results, the track record of consistently increasing dividends for multiple decades can provide confidence to investors regarding the strength and stability of these companies. However, it is essential to note that investing solely in dividend aristocrats or dividend kings does not guarantee investment success. Diversification and careful consideration of individual company fundamentals are still key components of a well-rounded investment strategy. In the next section, we will explore how to screen for dividend growth companies, allowing investors to identify potential candidates for their dividend growth portfolios. 5.3 Screening for dividend growth companies. When it comes to investing in dividend growth stocks, one of the key steps is to identify and screen for companies that have a track record of consistently increasing their dividends over time. These companies are often referred to as dividend growth companies, and they can be an excellent choice for investors looking to maximize their dividend returns. Screening for dividend growth companies involves a systematic process of analyzing various financial metrics and fundamental indicators to identify companies that meet specific criteria. By utilizing this screening process, investors can narrow down their focus to a select group of companies that have a higher likelihood of delivering consistent and growing dividends. 5.3.1 Dividend Growth Metrics. When screening for dividend growth companies, several key metrics and indicators can help investors identify potential candidates. These metrics are often used to evaluate a company's ability to sustain and increase dividends over time. 1. Dividend growth rate. The dividend growth rate measures the annualized percentage increase in a company's dividend over a specific period. A higher dividend growth rate indicates that a company has a consistent track record of increasing its dividends, which can be a positive sign for investors. 2. Dividend payout ratio. The dividend payout ratio is the proportion of a company's earnings that is paid out as dividends to shareholders. A lower payout ratio indicates that a company retains a larger portion of its earnings for reinvestment, which can support future dividend growth. 3. Earnings growth. Companies with consistent earnings growth are more likely to maintain and increase their dividends. By evaluating a company's historical and projected earnings growth, investors can gauge its ability to generate the necessary cash flows to sustain dividend payments. 4. Free cash flow. Free cash flow represents the cash a company generates after accounting for operating expenses and capital expenditures. Companies with positive and growing free cash flow are better positioned to support dividend growth over time. 5.3.2 Fundamental Analysis. In addition to specific dividend growth metrics, conducting a thorough fundamental analysis of potential candidates is crucial when screening for dividend growth companies. Fundamental analysis involves assessing a company's financial health, competitive position, and industry dynamics to determine its long-term viability as an investment. Key factors to consider during fundamental analysis include 1. Financial statements. Analyzing a company's income statement, balance sheet, and cash flow statement provides insights into its financial performance, liquidity, and debt levels. Reviewing these statements can help identify potential red flags or areas of strength. 2. Competitive advantage. Assessing a company's competitive advantage is essential in evaluating its long-term growth potential. Companies with durable competitive advantages, such as strong brands, unique products, services, or significant market share, are more likely to sustain dividend growth. 3. Industry dynamics. Understanding the industry in which a company operates is vital for evaluating its growth prospects. Factors such as market demand, industry competition, and regulatory environment can influence a company's ability to generate consistent earnings and sustain dividends. 4. Management quality. Evaluating the quality and track record of a company's management team is crucial. A competent management team with a solid strategy and a history of prudent capital allocation is more likely to navigate challenges and deliver sustainable dividend growth. 5.3.3 Dividend Growth Screening Tools. To facilitate the screening process, investors can utilize various screening tools and platforms available online. These tools allow investors to set specific criteria and parameters to filter and identify dividend growth companies that meet their preferences. Some popular dividend growth screening tools include 1. Stock Screeners. Stock screeners are online tools that allow investors to filter stocks based on specific criteria such as dividend yield, dividend growth rate, earnings growth, and financial ratios. Users can input their desired values for these metrics and screen for companies that meet their criteria. 2. Financial websites. Financial websites that provide access to company financial data, stock quotes, and investment analysis can also be valuable resources for screening dividend growth stocks. These websites often offer customizable search filters and stock screeners to assist investors in identifying potential dividend growth companies. 3. Dividend-focused newsletters. Subscribing to dividend-focused newsletters can provide valuable insights and recommendations on dividend growth stocks. These newsletters often provide detailed analysis, including potential dividend growth candidates based on specific criteria. 5.3.4 Diversification and Risk Management. While screening for dividend growth companies is an important step in maximizing dividend returns, it is essential to remember the principles of diversification and risk management. Diversifying your dividend portfolio across different sectors and industries can help mitigate risk and reduce the impact of any individual company's dividend reductions or suspensions. Additionally, investors should consider their risk tolerance and investment objectives when selecting dividend growth stocks. High dividend yields may seem attractive, but they can also be a sign of financial distress or unsustainable dividend payouts. It is crucial to strike a balance between yield and dividend sustainability. By conducting thorough research, utilizing screening tools, and diversifying one's portfolio, investors can increase their chances of identifying and investing in dividend growth companies that can provide consistent and growing dividend returns over the long term. However, it is important to note that no screening process can guarantee future performance, and regular monitoring and adjustment of the portfolio are necessary to adapt to changing market conditions. 5.4 Long-term prospects of dividend growth investing. Dividend growth investing is a strategy that focuses on investing in companies that have a strong track record of increasing their dividends over time. This approach capitalizes on the power of compounding returns, allowing investors to benefit from the potential for increasing income and, in turn, greater wealth accumulation over the long term. The power of dividend growth. Dividend growth investing is based on the premise that companies with a history of increasing their dividends tend to perform well over time. These companies have a solid financial foundation, generate consistent profits, and have the ability to reward shareholders through regular dividend increases. By investing in such companies, investors have the opportunity to participate in their success and enjoy the compounding effect of growing dividends. One of the key advantages of dividend growth investing is the potential for stable and increasing income streams. As companies increase their dividends, investors receive larger cash payments each year. These growing dividends not only provide an additional source of income, but also act as a buffer against inflation. In an era of low interest rates, dividend growth investing has become an attractive option for generating income and preserving purchasing power. Time horizon and dividend growth. The long-term prospects of dividend growth investing can be amplified by the time horizon of the investor. By taking a long-term approach, investors allow their investments to compound and benefit from the effects of dividend growth over many years. The compounding effect is especially powerful in dividend growth investing because as dividends increase, the absolute growth rate also increases, leading to larger returns over time. Let's consider an example to illustrate the power of compounding dividend returns. Assume you invest $10,000 in a dividend growth stock with a dividend yield of 3% and an average annual dividend growth rate of 7%. In the first year, you would receive $300 in dividends. However, over the next 5 years, with a dividend growth rate of 7%, your annual dividends would grow to approximately $400. By the 10th year, your annual dividends would reach around $620. If you reinvest these dividends back into the same stock, the number of shares you own would increase over time. As the number of shares grows, so does the dividend income. By the end of the 10th year, your initial investment of $10,000 would have grown to approximately $16,833, assuming no capital appreciation in the stock price. This represents a compounded annual growth rate, CAGR, of approximately 5.8%. As you can see from this example, dividend growth investing has the potential to create exponential wealth accumulation over the long term. By reinvesting dividends and allowing them to compound over time, investors can significantly enhance their returns and build a solid financial foundation for the future. Benefits of dividend growth investing. Investors who adopt a dividend growth investing strategy can enjoy several benefits, including stable income. Dividend growth investing provides a reliable and growing stream of income, making it a suitable strategy for income-focused investors, retirees, and those seeking regular cash flow. Wealth accumulation. By reinvesting dividends, investors can take advantage of the compounding effect, allowing their investment to grow over time. This can significantly enhance wealth accumulation and provide a source of financial security in the future. Inflation protection. Dividend growth investing can act as a hedge against inflation. As dividends increase over time, the income received keeps pace with rising prices, helping to protect the purchasing power of the investor's capital. Lower volatility. Dividend growth stocks tend to be less volatile than non-dividend paying stocks. The steady income provided by dividends can help cushion the impact of market downturns and smooth out portfolio returns. Long-term growth potential. Companies that consistently raise their dividends often have solid financial fundamentals and strong growth prospects. By investing in these companies, investors position themselves to benefit from the long-term growth potential of such businesses. Risks and considerations. While dividend growth investing offers numerous benefits, it's important to consider the potential risks and make informed investment decisions. Some key risks to be aware of include dividend cuts. Companies can reduce or eliminate dividends due to changes in their financial performance, economic downturns, or other unforeseen circumstances. This can negatively impact the income stream and reduce the potential for compounding returns. Sector risks. Certain sectors, such as technology or healthcare, may not traditionally offer high dividend yields. Investors should be mindful of sector-specific risks when selecting dividend growth stocks and ensure diversification to mitigate risk. Market conditions. Economic cycles and market fluctuations can impact the performance of dividend growth stocks. Investors need to consider the overall market conditions and assess the potential risks before making investment decisions. Valuation. Dividend growth stocks can sometimes become overvalued, leading to lower future returns. It's essential to evaluate the valuation of dividend growth stocks and consider the potential for future dividend growth before making investment decisions. Overall, dividend growth investing has shown strong long-term prospects for generating wealth and income. By harnessing the power of compounding returns, investors can benefit from increasing dividends, build a stable income stream, and potentially achieve their financial goals over time. However, it's important to conduct thorough research, evaluate the risks, and diversify investments to make informed decisions that align with individual financial objectives. 6. Maximizing dividend returns. 6.1 Strategies for maximizing dividend returns. When it comes to maximizing dividend returns, investors have several strategies at their disposal. By carefully selecting the right stocks, timing dividend reinvestment, managing portfolio allocation, and utilizing tax-efficient dividend investing techniques, investors can enhance their overall returns and compound their dividend income over time. In this section, we will explore these strategies in detail and provide guidance on how to effectively implement them. Selecting high-quality dividend stocks. One of the key steps in maximizing dividend returns is selecting high-quality dividend stocks. These are companies that not only offer attractive dividend yields but also have a strong track record of consistent dividend payments. When evaluating potential stocks, investors should consider factors such as the company's financial health, profitability, cash flow generation, and dividend growth history. Investors should look for companies with a history of increasing dividend payments over time, as this demonstrates the management's commitment to providing a growing income stream to shareholders. Dividend aristocrats and dividend kings are particularly appealing in this regard, as they are companies that have consistently increased their dividends for at least 25 and 50 consecutive years, respectively. Furthermore, investors should analyze the dividend payout ratio, which is the proportion of earnings a company pays out as dividends. A low payout ratio indicates that the company has room to increase dividends in the future, while a high payout ratio suggests that the company may not be sustainable in maintaining or growing its dividends. By conducting thorough research and analysis, investors can identify high-quality dividend stocks that have the potential for capital appreciation and consistent dividend growth, ultimately maximizing their dividend returns. Timing dividend reinvestment. Another strategy for maximizing dividend returns is timing dividend reinvestment. Instead of immediately reinvesting dividends received, investors can strategically time their reinvestment to take advantage of market conditions. One approach is to accumulate dividends in a separate cash account and wait for favorable buying opportunities in the stock market. By timing the reinvestment during market downturns or when the stock price is undervalued, investors can acquire more shares for the same amount of money, ultimately maximizing their dividend returns in the long run. However, it's important to note that timing the market is a challenging task, and it requires a deep understanding of market dynamics and a disciplined approach. Attempting to time the market without proper knowledge and analysis can lead to suboptimal results or missed investment opportunities. Therefore, investors should carefully assess their own abilities and consult with financial advisors if needed. Managing portfolio allocation. Proper portfolio allocation is essential for maximizing dividend returns. Diversifying across different sectors and industries can help reduce the risk associated with individual stocks and safeguard against potential dividend cuts or suspensions. Investors should consider allocating their portfolio to a mix of dividend-paying stocks with varying dividend growth rates and dividend yields. This balanced approach can provide a steady income stream while ensuring the potential for long-term capital appreciation. Furthermore, investors should periodically review and rebalance their portfolio to maintain the desired allocation. As market conditions and individual stock performances change, rebalancing can help ensure that the portfolio remains aligned with the investor's goals and risk tolerance. Tax-efficient dividend investing. Finally, implementing tax-efficient dividend investing techniques can significantly enhance dividend returns. Dividends are subject to different tax rates depending on the investor's tax bracket and the type of dividends received. By employing tax-efficient strategies, investors can minimize their tax liabilities and maximize their after-tax returns. One approach is to hold dividend-paying stocks in tax-advantaged accounts such as individual retirement accounts, IRAs, or 401ks. These accounts offer tax advantages, such as tax-deferred growth or tax-free withdrawals, allowing investors to maximize their dividend returns. Another strategy is to focus on investing in qualified dividends, which are subject to lower tax rates compared to non-qualified dividends. Qualified dividends are usually paid by domestic corporations or qualified foreign corporations that meet specific criteria. By investing in companies that pay qualified dividends, investors can reduce the tax burden on their dividend income. Additionally, investors can utilize tax loss harvesting, where capital losses are used to offset capital gains or taxable income. This strategy helps reduce overall tax liabilities and frees up capital that can be reinvested to further compound dividend returns. By implementing these tax-efficient strategies, investors can enhance their after-tax dividend returns and accelerate the growth of their investment portfolios. In conclusion, maximizing dividend returns requires careful consideration of different strategies. By selecting high-quality dividend stocks, timing dividend reinvestment, managing portfolio allocation, and employing tax-efficient dividend investing techniques, investors can maximize their overall returns and benefit from the power of compounding. It is crucial for investors to conduct thorough research, consult with financial advisors if needed, and regularly monitor and adjust their dividend portfolios to ensure long-term success in maximizing dividend returns. 6.2 Timing dividend reinvestment. When it comes to maximizing dividend returns, timing dividend reinvestment is a crucial factor to consider. Dividend reinvestment involves using the cash dividends received from your investments to purchase additional shares of the same stock or fund. This process allows you to take advantage of compounding and potentially accelerate the growth of your investment portfolio over time. Timing dividend reinvestment effectively involves making informed decisions about when to reinvest your dividends to achieve the best possible returns. While it may be tempting to automatically reinvest dividends as soon as they are received, taking a strategic approach can yield better results. Here are some key considerations to help you make informed decisions about timing dividend reinvestment. Consider the Dividend Reinvestment Plan, DRIP. Dividend reinvestment plans, or DRIPs, allow you to automatically reinvest your dividends back into the same stock or fund without incurring brokerage fees. DRIPs typically offer attractive features such as discounted stock prices or fractional share purchases. It's important to evaluate the terms and conditions of each DRIP and consider whether it aligns with your investment goals. Some DRIPs may have specific reinvestment dates or timeframes, which could influence your timing decisions. Regularly review dividend payment dates. Dividend payments are typically scheduled for specific dates throughout the year or on a quarterly basis. By tracking the dividend payment dates of your investments, you can estimate when the cash will be available for reinvestment. This allows you to plan your reinvestment strategy accordingly. If you have multiple dividend-paying investments, consider diversifying your reinvestments over different payment dates to ensure a consistent flow of reinvestment opportunities throughout the year. Evaluate market conditions. Market conditions can influence the timing of dividend reinvestment. During periods of market volatility or economic uncertainty, you may choose to hold on to your cash dividends and wait for potential buying opportunities. Alternatively, when the market is performing well and stock prices are high, it may be advantageous to reinvest your dividends promptly to take advantage of potential future growth. Keeping an eye on market trends and understanding your investment objectives will help guide your decisions. Reinvest dividends in undervalued stocks. One strategy to consider is reinvesting your dividends in stocks that are currently undervalued. By accumulating shares of undervalued stocks through dividend reinvestment, you can potentially capitalize on future price appreciation when the market recognizes their true value. This approach requires careful evaluation of the fundamentals and potential growth prospects of specific companies or sectors. Account for taxes. Taxes are an important consideration when timing dividend reinvestment. Reinvesting dividends within tax-advantaged accounts, such as individual retirement accounts (IRAs) or 401k plans, can help you defer tax payments on dividends until withdrawal. However, if you reinvest dividends outside of tax-advantaged accounts, you may be liable for taxes on the dividend income received. Consult with a tax professional to understand the tax implications of dividend reinvestment and make informed decisions based on your individual tax situation. Monitor investment goals and portfolio allocation. Timing dividend reinvestment should align with your overall investment goals and portfolio allocation strategy. Regularly review and assess your investment portfolio to ensure that it remains aligned with your risk tolerance and long-term objectives. If a stock or fund in which you are reinvesting dividends no longer fits your investment strategy, it may be time to reassess and consider reallocating your funds. Dollar cost averaging. Dollar cost averaging is a strategy where you invest a fixed amount at regular intervals, regardless of the current market price. Applying this strategy to dividend reinvestment can help smooth out the impact of market fluctuations and potentially reduce the risk of making poor timing decisions. By consistently reinvesting dividends over time, you can accumulate a larger number of shares when prices are low and fewer shares when prices are high. In conclusion, timing dividend reinvestment is an important aspect of maximizing dividend returns. By considering factors such as DRIPs, dividend payment dates, market conditions, undervalued stocks, taxes, investment goals, portfolio allocation, and dollar cost averaging, you can make informed decisions about when to reinvest your dividends. Remember that successful dividend reinvestment requires a blend of patience, research, and a long-term perspective to benefit from the power of compounding and potentially enhance your overall investment returns. 6.3 Managing portfolio allocation. One of the key strategies for maximizing dividend returns is effectively managing portfolio allocation. Portfolio allocation refers to the distribution of investment funds across different asset classes, sectors, and individual stocks within a dividend portfolio. By carefully selecting and diversifying investments, investors can optimize their dividend returns while managing risk. Importance of portfolio allocation. Portfolio allocation plays a crucial role in maximizing dividend returns for several reasons. Diversification. Diversification is a fundamental principle of portfolio allocation. By spreading investments across various asset classes, sectors, and individual stocks, investors can reduce their exposure to any single company or industry. This diversification helps to mitigate risk and protect against potential losses. Diversifying dividend investments is especially important as it allows investors to access a wide range of income-generating assets. By holding a diversified portfolio of dividend stocks, investors can benefit from stable cash flows even if some individual stocks reduce or eliminate their dividends. Risk management. Effective portfolio allocation also helps manage risk. Dividend stocks can be subject to market volatility and other risks, such as regulatory changes or economic downturns. By diversifying across different sectors, industries, and geographic regions, investors can reduce the impact of any one stock or risk factor on their overall dividend income. Allocating investments based on risk tolerance is another important aspect of portfolio management. Investors with a higher risk tolerance may allocate a larger portion of their portfolio to higher yielding but more volatile dividend stocks, while those with a lower risk tolerance may favor more stable, lower yielding dividend stocks. Balancing risk and reward is key to maximizing dividend returns over the long term. Capital preservation. Effective portfolio allocation also takes into account the preservation of capital. While dividend stocks can provide attractive yields, it is important to ensure that the investments have the potential for long-term capital appreciation. Allocating a portion of the portfolio to stocks with solid growth prospects can help generate both income and capital gains. By diversifying across different asset classes, including dividend stocks, bonds, and other income-generating investments, investors can create a well-rounded portfolio that aims to preserve and grow their capital over time. This balancing act between income and growth potential is an important aspect of managing portfolio allocation. Strategies for managing portfolio allocation. When managing portfolio allocation within a dividend-focused investment strategy, there are several strategies that investors can employ to maximize dividend returns. Sector allocation. Allocating investments across different sectors can help diversify risk and take advantage of opportunities in various industries. Some sectors, such as utilities and consumer staples, are known for their historically stable dividend payments. Other sectors, such as technology or healthcare, may offer higher growth potential but carry greater volatility. By diversifying across sectors, investors can capture both stable income and growth opportunities. Geographic allocation. Geographic allocation involves investing in dividend stocks from different countries and regions. This strategy allows investors to diversify across different economies and currencies, spreading the risk associated with fluctuations in any particular market. Investing internationally also provides access to dividend stocks in sectors and industries that may not be well represented in the investor's domestic market. Market capitalization allocation. Market capitalization allocation refers to investing across different sized companies. Dividend stocks can be found in large cap, mid cap, and small cap companies. Large cap companies often provide more stable dividends, while mid cap and small cap stocks may offer higher growth potential. By allocating investments across different market capitalizations, investors can balance income and growth potential within their dividend portfolio. Dividend growth versus high dividend yield. Another consideration when managing portfolio allocation is a balance between dividend growth stocks and high dividend yield stocks. Dividend growth stocks are companies that consistently increase their dividend payments over time. These stocks may have a lower dividend yield initially but offer the potential for significant income growth. High dividend yield stocks, on the other hand, provide higher current income but may have limited dividend growth. Balancing these two types of stocks can help optimize dividend returns. Regular review and adjustment. Managing portfolio allocation is an ongoing process that requires regular review and adjustment. Market conditions, economic factors, and changes in individual company performance can all impact the performance of dividend stocks. It is important for investors to monitor their portfolio, assess the performance of individual investments, and make adjustments as needed. This can involve rebalancing the portfolio, adding or removing specific stocks, or adjusting the allocation across sectors and asset classes. Investing in dividend stocks is a long-term strategy aimed at generating consistent income and growing wealth. By effectively managing portfolio allocation, diversifying investments, and balancing risk and reward, investors can maximize their dividend returns and achieve their financial goals. Regular monitoring and adjustment of the portfolio, aligned with the investor's risk tolerance and investment objectives, are key to long-term dividend success. 6.4 Tax-efficient dividend investing. When it comes to maximizing dividend returns, investors often focus on strategies such as reinvesting dividends and portfolio allocation. However, one aspect that is often overlooked is the impact of taxes on dividend returns. Taxes can significantly affect the after-tax income from dividends, and implementing tax-efficient strategies can help investors keep more of their dividend income. In this section, we will explore the concept of tax-efficient dividend investing and discuss strategies that can help investors minimize their tax liabilities while maximizing their dividend returns. Understanding taxation of dividends. Before diving into tax-efficient strategies, it is essential to understand how dividends are taxed. Dividends can be classified into two categories: qualified dividends and non-qualified dividends. Qualified dividends are subject to preferential tax rates, which are typically lower than ordinary income tax rates. On the other hand, non-qualified dividends are taxed at the investor's ordinary income tax rate. The tax rates on qualified dividends depend on the investor's tax bracket. For 2021, the tax rates on qualified dividends are as follows: 0% tax rate for individuals in the 10% and 12% tax brackets, 15% tax rate for individuals in the 22%, 24%, 32%, and 35% tax brackets, 20% tax rate for individuals in the 37% tax bracket. It is crucial to note that the tax rates on qualified dividends may change over time due to tax policy changes. Minimizing taxes on dividends. Now that we understand the tax implications of dividends, let's explore some strategies for minimizing taxes on dividend income. 1. Invest in tax-advantaged accounts. One of the most effective ways to minimize taxes on dividend income is to invest in tax-advantaged accounts such as individual retirement accounts, IRAs, or 401k plans. Contributions to these accounts are typically tax-deductible, and any dividends earned within the account grow tax-deferred. In a traditional IRA or 401k plan, dividends are not taxed until withdrawal, allowing for potential tax savings and the opportunity for compounding growth. 2. Hold dividend stocks in taxable accounts wisely. While tax-advantaged accounts offer tax benefits for dividend investing, it is not always possible or desirable to invest solely within these accounts. For investors who hold dividend stocks in taxable accounts, it can be beneficial to consider the tax implications when selecting which stocks to hold. Some stocks may generate a higher amount of non-qualified dividends due to their business structure or payout policies. By focusing on stocks that pay qualified dividends, investors can take advantage of lower tax rates. Additionally, minimizing turnover and holding stocks for the long term can help reduce taxable events and potential capital gains taxes. 3. Tax loss harvesting. Tax loss harvesting is a strategy that involves selling securities that have experienced losses to offset capital gains or reduce taxable income. By strategically harvesting losses, investors can minimize their overall tax liability. With dividend investing, tax loss harvesting can be used to offset any taxable dividend income with losses realized from other investments. However, it is essential to comply with the wash sale rule, which prohibits repurchasing the same or substantially identical assets within 30 days to claim the loss for tax purposes. 4. Consider municipal bonds. Municipal bonds, or munis, are debt securities issued by state and local governments. Unlike dividends, interest income from municipal bonds is generally tax-exempt at the federal level and sometimes at the state level, depending on the investor's residency and the bond issuer. By including municipal bonds in their portfolio, investors can generate tax-free income, thus reducing their overall tax liability. However, it is crucial to consider the credit quality and risk factors associated with municipal bonds before investing. Seek professional advice. While the strategies mentioned above can be useful in minimizing taxes on dividend income, it is essential to consult with a qualified tax advisor or financial planner. Tax laws can be complex and subject to change, and professional guidance can help navigate the intricacies of tax-efficient dividend investing. Furthermore, an advisor can assess an investor's individual circumstances and recommend personalized tax strategies that align with their financial goals. Conclusion. Maximizing dividend returns goes beyond simply reinvesting dividends and managing portfolio allocation. Taxes play a crucial role in determining the after-tax income from dividends, and implementing tax-efficient strategies can help investors keep more of their hard-earned income. By investing in tax-advantaged accounts, considering the tax implications of holding dividend stocks, utilizing tax loss harvesting, and exploring tax-exempt investments like municipal bonds, investors can minimize their tax liability and maximize their dividend returns. Remember to consult with a qualified tax advisor or financial planner to tailor these strategies to your specific circumstances and goals. 7. Dividend reinvestment vehicles. 7.1 Direct Stock Purchase Plans, DSPPs. Direct Stock Purchase Plans, DSPPs, are a popular and accessible method for individual investors to maximize their dividend returns. These plans allow investors to purchase shares of a company's stock directly from the company, bypassing the need for a broker or middleman. DSPPs offer a convenient and cost-effective way to invest in dividend stocks and take advantage of the power of compounding. How DSPPs work. DSPPs are typically offered by large publicly traded companies that have a history of paying consistent and reliable dividends. Through these plans, investors can buy shares of a company's stock directly from the company, often at a discount to the market price. DSPPs usually require a minimum initial investment, which can vary depending on the company. Investors participating in a DSPP also have the option to reinvest their dividends automatically. This means that instead of receiving dividend payments in cash, the investor's dividends are used to purchase additional shares of the company's stock. This reinvestment of dividends allows investors to compound their returns over time, as each reinvestment adds to the investor's ownership stake in the company and increases the potential for future dividend payouts. Benefits of DSPPs for dividend investors. 1. Cost-effective. DSPPs typically have lower fees compared to traditional brokerage accounts, making them an affordable option for individual investors. This is especially advantageous for investors who want to regularly reinvest their dividends, as they can do so without incurring high transaction costs. 2. Access to dividend aristocrats. Many DSPPs are offered by companies that are part of the prestigious Dividend Aristocrats Index, which consists of companies that have a proven track record of consistently increasing their dividends for at least 25 consecutive years. By investing directly in these companies through a DSPP, investors gain exposure to high-quality dividend stocks known for their stability and long-term performance. 3. Dividend reinvestment. DSPPs often offer automatic dividend reinvestment, allowing investors to compound their returns without the need for manual intervention. Reinvesting dividends helps to accelerate wealth accumulation over time, as the increased number of shares owned generates even higher dividend payments in subsequent periods. 4. Direct ownership. DSPPs provide investors with direct ownership of company stock. This direct ownership comes with certain advantages, such as the ability to vote on certain corporate matters and to participate in company stock purchase plans or employee stock ownership plans (ESOPs) if offered. 5. Long-term investment focus. DSPPs encourage a long-term investment perspective as they discourage frequent buying and selling of shares. This aligns with the dividend investing philosophy, which emphasizes the benefits of holding onto shares for extended periods to fully capture the compounding effect of dividends. Considerations for DSPP investors. 1. Limited investment options. DSPPs typically offer a limited selection of companies in which investors can participate. It's important to research and carefully evaluate the available options to ensure they align with your investment goals and risk tolerance. 2. Lack of diversification. Depending solely on a selected DSPP for your dividend portfolio may result in an undiversified portfolio. It is recommended to combine DSPP investments with other dividend-paying stocks or investment vehicles to achieve adequate diversification and manage risk effectively. 3. Tax implications. DSPPs have tax implications, especially if dividends are reinvested. Reinvested dividends are generally considered taxable income, even though the investor does not receive them in cash. Understanding the tax rules and consulting with a tax professional is crucial to ensure compliance and make informed investment decisions. 4. Administrative procedures. DSPPs may require additional paperwork and administrative procedures compared to traditional brokerage accounts. This may include enrollment forms, account maintenance activities, and communication with the plan administrator. Selecting and enrolling in a DSPP. When considering a DSPP, it's essential to research and compare different plans to find the one that best suits your investment objectives. Here are some factors to consider when selecting and enrolling in a DSPP. 1. Company research. Evaluate the companies offering DSPPs and focus on those with a solid history of dividend payments and consistent growth. Additionally, consider the company's financial health, industry dynamics, and competitive advantages. 2. Investment minimums. Understand the minimum investment requirements for each DSPP. Some plans may have higher minimums, making them more suitable for investors with larger portfolios. 3. Fees and costs. Compare the fees associated with each DSPP, including account setup fees, transaction fees, and ongoing maintenance fees. Look for plans with competitive fees to maximize your returns. 4. Dividend reinvestment. Ensure that the DSPP offers automatic dividend reinvestment if that is a key objective for your investment strategy. Reinvesting dividends is crucial for harnessing the power of compounding over time. 5. Plan restrictions. Be aware of any restrictions imposed by the DSPP, such as limitations on buying or selling shares, holding periods, or eligibility criteria. Ensure the plan aligns with your investment goals and preferences. Once you have selected a suitable DSPP, you can enroll directly through the company's website or by contacting their plan administrator. Provide the necessary information and complete the required paperwork to begin investing in the company's stock through the DSPP. DSPPs provide individual investors with a direct and cost-effective means to leverage the power of compounding and maximize dividend returns. By bypassing traditional brokers, investors can take advantage of automatic dividend reinvestment and gain direct ownership in high-quality dividend-paying companies. However, it is important to carefully consider the investment options, tax implications, and other factors before enrolling in a DSPP. Ultimately, DSPPs can be a valuable tool for dividend investors looking to optimize their returns and build a robust dividend portfolio. 7.2 Exchange-Traded Funds, ETFs. Exchange-Traded Funds, ETFs, have gained significant popularity as investment vehicles for dividend investors. These funds provide a convenient and cost-effective way to participate in the power of compounding and maximize dividend returns. In this section, we will explore the benefits of ETFs for dividend investors and discuss how to effectively utilize them in your investment strategy. Understanding ETFs. Before diving into the specifics of using ETFs for dividend investing, it's important to have a clear understanding of what ETFs are. An ETF is a type of investment fund that trades on stock exchanges, similar to individual stocks. It holds a diversified portfolio of assets, such as stocks, bonds, or commodities, and aims to replicate the performance of a specific index or sector. ETFs offer several advantages that make them attractive to dividend investors. Firstly, they provide instant diversification by holding a basket of securities, which helps reduce the risk associated with individual stock investments. Secondly, ETFs offer liquidity, as they can be easily bought or sold throughout the trading day. Additionally, ETFs usually have lower expense ratios compared to actively managed mutual funds, making them a cost-effective investment option. Dividend-focused ETFs. Dividend-focused ETFs are specifically designed for investors seeking regular income from their investments. These funds typically hold a portfolio of dividend-paying stocks and aim to provide a steady stream of dividends to shareholders. Investing in dividend-focused ETFs can be an efficient way to participate in the power of compounding and maximize your dividend returns. When selecting a dividend-focused ETF, it's essential to consider the fund's investment strategy, dividend yield, and track record. Some ETFs focus on high dividend yield, while others concentrate on dividend growth companies. It's crucial to align your investment objectives with the ETF strategy to ensure it matches your financial goals and risk tolerance. Benefits of dividend ETFs. Dividend-focused ETFs offer several benefits for investors looking to maximize their dividend returns. Here are some key advantages. 1. Instant diversification. By investing in a dividend-focused ETF, you gain exposure to a diversified portfolio of dividend-paying stocks across different sectors and industries. This diversification helps reduce the risk associated with individual stock selection and provides a more stable income stream. 2. Regular income. Dividend-focused ETFs aim to generate a regular income stream for investors. These funds typically distribute dividends on a quarterly basis, allowing investors to benefit from consistent cash flow. Reinvesting these dividends further enhances the power of compounding and helps accelerate your investment growth. 3. Professional management. ETFs are managed by professional investment managers who analyze and select the portfolio holdings. This expertise ensures that the fund invests in high-quality dividend-paying companies, increasing the likelihood of consistent dividend payments and potential capital appreciation. 4. Lower costs. Compared to actively managed mutual funds, ETFs generally have lower expenses. This cost advantage is primarily due to their passive management approach, where the fund aims to replicate the performance of an index rather than actively selecting stocks. Lower expenses mean more of your investment goes towards dividends, enhancing your overall returns. 5. Liquidity. ETFs trade on stock exchanges, providing investors with liquidity throughout the trading day. This allows you to buy or sell ETF shares at prevailing market prices, providing flexibility to manage your investment portfolio based on market conditions or personal circumstances. Incorporating dividend ETFs into your strategy. To effectively utilize dividend-focused ETFs in your investment strategy, consider the following tips. 1. Research and select suitable ETFs. Do thorough research to identify dividend-focused ETFs that align with your investment objectives. Evaluate factors such as the fund's investment strategy, historical performance, dividend yield, expense ratio, and underlying holdings. Make an informed decision based on your financial goals, risk tolerance, and time horizon. 2. Diversify your ETF holdings. Just as you diversify your stock portfolio, it's important to diversify your ETF holdings. Consider investing in multiple dividend-focused ETFs to gain exposure to a broader range of dividend-paying stocks and sectors. This diversification helps mitigate risk and enhances the stability of your dividend income. 3. Reinvestment options. Some dividend ETFs offer dividend reinvestment plans, DRIPs, allowing you to automatically reinvest your dividends back into the fund. This reinvestment helps compound your returns over time and accelerates the growth of your investment. Evaluate and select ETFs that provide this option if it aligns with your investment strategy. 4. Regular monitoring and review. As with any investment, it's essential to regularly monitor your dividend ETF holdings and review their performance. Stay informed about any changes in the fund's strategy, management team, or underlying holdings. Monitor dividend payment history and any changes in dividend payout ratios. This information will help you make informed decisions and take necessary actions to optimize your returns. Incorporating dividend-focused ETFs into your investment strategy can be a powerful way to maximize your dividend returns. By utilizing the advantages of diversification, regular income, professional management, lower costs, and liquidity, you can harness the potential of compounding and accelerate the growth of your dividend portfolio. As with any investment, thorough research, careful selection, and regular monitoring are crucial to ensure your dividend ETFs align with your financial goals and risk appetite. 7.3 Dividend-focused mutual funds. Dividend-focused mutual funds are investment vehicles that specifically aim to generate income through dividends. These funds pool money from multiple investors and invest in a diversified portfolio of dividend-paying stocks. By investing in dividend-focused mutual funds, investors can gain exposure to a wide range of dividend-paying companies without having to analyze and select individual stocks themselves. Understanding dividend-focused mutual funds. Dividend-focused mutual funds are managed by professional fund managers who conduct thorough research and analysis to identify high-quality dividend-paying stocks. These funds typically invest in companies that have a consistent track record of paying dividends and exhibiting a strong dividend growth history. The fund managers focus on selecting stocks from various industries and sectors to diversify the fund's holdings and reduce risk. The primary objective of dividend-focused mutual funds is to generate a steady stream of income for investors. These funds typically distribute dividends to their investors on a quarterly or annual basis. The dividend income is derived from the underlying stocks held by the mutual fund. Advantages of dividend-focused mutual funds. Diversification. Dividend-focused mutual funds provide instant diversification by investing in a wide range of dividend-paying stocks. This diversification helps reduce the risk associated with investing in individual stocks. By spreading the investment across multiple companies, the impact of any single company's performance on the overall portfolio is minimized. Professional management. By investing in dividend-focused mutual funds, investors benefit from the expertise of professional fund managers. These managers have access to extensive research and resources, enabling them to make informed investment decisions. They continuously monitor and adjust the fund's holdings based on changing market conditions and company performance. Dividend reinvestment. Many dividend-focused mutual funds offer the option to reinvest dividends automatically. This means that any dividends earned by the fund are used to purchase additional shares of the fund, compounding the potential for future returns. Dividend reinvestment allows investors to take advantage of the power of compounding and accumulate more shares over time. Liquidity. Dividend-focused mutual funds are highly liquid investment vehicles. Investors can buy or sell shares of these funds at any time, typically at the end of each trading day. This provides investors with flexibility and the ability to access their investment capital when needed. Low initial investment. Dividend-focused mutual funds offer relatively low minimum investment requirements, making them accessible to a wide range of investors. This allows individuals with limited capital to invest in a diversified portfolio of dividend-paying stocks. Evaluating dividend-focused mutual funds. When considering investing in dividend-focused mutual funds, it's essential to evaluate several factors to make an informed decision. Investment objective. Understand the investment objective of the mutual fund. Some funds may focus on high dividend yield, while others may emphasize dividend growth or a combination of both. Determine if the fund's investment objective aligns with your investment goals. Fund performance. Review the historical performance of the mutual fund over different time periods. Evaluate the fund's return compared to its benchmark index and peer group. It's essential to assess the consistency of the fund's performance and how it has weathered different market conditions. Expense ratio. Consider the expense ratio, which represents the annual fees and expenses associated with owning the mutual fund. Lower expense ratios are generally more favorable, as they can have a significant impact on long-term returns. Dividend history. Evaluate the fund's dividend payment history. Look for funds that have a consistent track record of paying dividends and increasing dividend payments over time. Assess the fund's dividend yield and compare it to similar funds. Fund holdings. Review the fund's holdings to determine the diversification and quality of the stocks it invests in. Pay attention to the sectors and industries represented in the fund's portfolio and ensure they align with your investment preferences. Fund manager. Consider the experience and track record of the fund manager managing the dividend-focused mutual fund. Review their investment approach, philosophy, and the team supporting them. A skilled and experienced fund manager can significantly impact the fund's performance. Risks of dividend-focused mutual funds. While dividend-focused mutual funds offer several advantages, it's crucial to understand and consider the associated risks. Market risk. Like any other investment, dividend-focused mutual funds are subject to market risks. The value of the fund's shares can fluctuate based on changes in the overall stock market or specific industry sectors. Interest rate risk. Dividend-focused mutual funds are particularly sensitive to changes in interest rates. When interest rates rise, bond yields may become more attractive to investors, causing stocks to lose value, and thus affecting the fund's performance. Dividend cuts. Although dividend-focused mutual funds aim to invest in stable and reliable dividend-paying companies, there is still the risk of a company cutting or suspending its dividend payments. Such actions can impact the fund's overall dividend income and potentially affect its performance. Manager risk. The performance of a dividend-focused mutual fund heavily relies on the skill and expertise of the fund manager. If the fund manager makes poor investment decisions or fails to adapt to market changes, it can negatively impact the fund's returns. To mitigate these risks, it's crucial for investors to conduct thorough research, diversify their investment portfolio, and regularly monitor the performance of their dividend-focused mutual fund investments. In conclusion, dividend-focused mutual funds offer investors a convenient and diversified way to invest in a portfolio of dividend-paying stocks. By carefully evaluating these funds based on their investment objectives, performance, expenses, and dividend histories, investors can choose funds that align with their investment goals and risk tolerance. Additionally, it's important to understand the risks associated with these funds and regularly review and adjust the investment strategy based on market conditions and changing investment goals. 7.4 Dividend Reinvestment Platforms. Dividend reinvestment is a powerful strategy that allows investors to compound their returns over time. By reinvesting dividends back into the same investment, investors can exponentially increase their holdings and potentially achieve significant wealth accumulation. To effectively implement dividend reinvestment, investors need reliable and user-friendly platforms that enable seamless reinvestment of dividends. In this section, we will explore some popular dividend reinvestment platforms that can help investors maximize their dividend returns. 7.4.1 Direct Stock Purchase Plans (DSPPs). Direct Stock Purchase Plans, commonly known as DSPPs, are programs offered by many publicly traded companies that allow investors to purchase shares of their stock directly from the company. DSPPs are a cost-effective and straightforward way to invest in dividend-paying stocks and typically have lower or no fees associated with them. One of the significant advantages of DSPPs is the ability to reinvest dividends automatically. When enrolled in a DSPP, investors have the option to reinvest their dividends directly back into additional shares of the company's stock without incurring any brokerage commissions. This reinvestment can be an attractive feature for long-term investors looking to compound their returns without any additional costs. DSPPs usually require a minimum initial investment, which can vary depending on the company. Investors can typically set up an account directly with the company or through a transfer agent that administers the DSPP. Some companies also offer the option to make recurring investments, allowing investors to contribute a fixed amount each month or quarter. While DSPPs offer a convenient way to reinvest dividends, it's important to note that they might have certain limitations. Not all companies offer DSPPs, and those that do may have specific eligibility criteria or restrictions on participation. Additionally, DSPPs may lack the diversification benefits that come with investing in a broader portfolio of stocks or funds. 7.4.2 Exchange-Traded Funds, ETFs. Exchange-traded funds, or ETFs, have gained significant popularity among investors due to their diverse range of investment options and low expense ratios. ETFs are investment funds that are traded on stock exchanges, similar to individual stocks. They offer investors exposure to a basket of securities, such as stocks, bonds, or commodities, representing a specific market or sector. When it comes to dividend reinvestment, many ETFs offer dividend reinvestment plans (DRIPs). These plans allow investors to automatically reinvest dividends back into the fund, effectively compounding their returns over time. By reinvesting dividends, investors can benefit from the power of compounding and potentially experience exponential growth in their investment. One of the advantages of using ETFs for dividend reinvestment is the ability to diversify across different companies, sectors, or asset classes with a single investment. This diversification can help reduce the risk associated with holding individual stocks. Additionally, ETFs often have lower expense ratios compared to actively managed funds, which can enhance overall returns over the long term. Investors can access a wide range of dividend-focused ETFs that target high dividend yields or dividend growth. These ETFs typically hold a portfolio of dividend-paying stocks and distribute the dividend income to their investors. By reinvesting these dividends back into the ETF, investors can harness the power of compounding and potentially achieve higher returns over time. 7.4.3 Dividend-Focused Mutual Funds. Dividend-focused mutual funds are another popular option for investors seeking to maximize their dividend returns. These funds are managed by professional portfolio managers who select a diversified portfolio of dividend-paying stocks based on their investment objectives and strategies. Like ETFs, many dividend-focused mutual funds offer dividend reinvestment as an automatic option for investors. Reinvesting dividends can help enhance long-term returns by compounding the dividend income and potentially leading to significant growth in the investment. Investing in dividend-focused mutual funds offers several advantages. Mutual funds provide instant diversification by pooling money from multiple investors and spreading it across a portfolio of securities. This diversification can help reduce the risk associated with holding individual stocks. Additionally, mutual funds are actively managed, meaning that professional portfolio managers make decisions regarding the fund's holdings, aiming to achieve the stated investment objectives. Investors can choose from a variety of dividend-focused mutual funds, each with its own investment style and approach. Some funds may focus on high dividend yield stocks, while others may target consistent dividend growers. It is essential for investors to carefully evaluate the fund's investment strategy, track record, and fees before investing. 7.4.4 Dividend Reinvestment Platforms. In addition to the specific dividend reinvestment options mentioned above, there are various online brokerage platforms and services that provide investors with dividend reinvestment capabilities. These platforms offer individuals the opportunity to invest in dividend-paying stocks, ETFs, or mutual funds, and reinvest their dividends effortlessly. Dividend reinvestment platforms allow investors to set up automatic reinvestment of dividends into additional shares of their chosen investment. Once dividends are received, the platform automatically executes the reinvestment based on the investor's preferences. These platforms typically provide investors with a wide selection of dividend-paying securities to choose from. They often offer comprehensive research tools and educational resources, allowing investors to make informed decisions about their dividend reinvestment strategy. Some dividend reinvestment platforms may also offer additional features, such as dividend tracking, performance analysis, and portfolio management tools. These features can help investors monitor their dividend investments, track their returns, and make adjustments to their portfolio as needed. When selecting a dividend reinvestment platform, investors should consider factors such as fees, customer service, user experience, platform reliability, and available investment options. It is essential to choose a platform that aligns with individual investment goals and provides the necessary tools and support for successful dividend reinvestment. In conclusion, dividend reinvestment platforms play a crucial role in maximizing dividend returns. Whether through direct stock purchase plans, ETFs, dividend-focused mutual funds, or online brokerage platforms, investors have a range of options to seamlessly and efficiently reinvest their dividends. By harnessing the power of compounding through dividend reinvestment, investors can potentially unlock significant wealth accumulation over time. 8. Dividend taxation. 8.1 Understanding dividend taxation. Dividend taxation is a crucial aspect of dividend investing that must be understood in order to maximize the returns on your investments. As an investor, it is important to be aware of the tax implications associated with dividend income, as they can have a significant impact on your overall returns. In this section, we will delve into the details of dividend taxation and explore the various aspects that investors need to consider. The basics of dividend taxation. Dividends are a form of income generated from owning shares of a company. When a company distributes its earnings to shareholders in the form of dividends, these payments are subject to taxation. The tax treatment of dividends varies depending on the jurisdiction in which you reside. In many countries, dividends are generally subject to tax at the individual level. The specific tax rates and rules can vary significantly from one country to another. It is important for investors to understand the tax laws in their respective jurisdictions to properly assess the impact of dividend taxation on their overall investment returns. Dividend tax rates. The tax rates applied to dividends can differ from the tax rates applied to other forms of income, such as wages or interest. In some countries, dividends may be subject to a preferential tax rate, which is often lower than the tax rate applied to ordinary income. This preferential treatment is designed to incentivize investment in stocks and support long-term investment growth. The tax rates on dividends can vary based on factors such as individual income levels, marital status, and the length of time the investment was held. It is essential to consult with a tax professional or refer to the tax guidelines provided by your local tax authority to determine the specific rates that apply to your situation. Qualified versus non-qualified dividends. Dividends are classified into two main categories, qualified and non-qualified dividends. The classification of dividends plays a crucial role in determining the tax treatment and the applicable tax rates. Qualified dividends are subject to a lower tax rate than non-qualified dividends. To qualify for this preferential tax treatment, dividends must meet certain criteria set by the tax authorities. Typically, dividends received from qualified domestic corporations and certain foreign corporations that meet specific criteria qualify for preferential tax rates. Non-qualified dividends, on the other hand, do not meet the criteria for preferential tax treatment. They are typically subject to the ordinary income tax rates that apply to other types of income. Non-qualified dividends are often derived from sources such as real estate investment trusts, REITs, mutual funds, and certain foreign investments. Considerations for tax-efficient dividend investing. When pursuing a tax-efficient dividend investing strategy, it is important to consider several factors that can help maximize your after-tax returns. Here are a few key points to keep in mind. 1. Understand your tax bracket. Understanding your tax bracket is crucial for determining the potential impact of dividend taxation on your overall investment returns. By knowing your tax bracket, you can estimate the taxes you will owe on your dividend income. This knowledge can help you make informed decisions about which dividend-paying stocks to invest in and when to take action. 2. Utilize tax-advantaged accounts. Tax-advantaged retirement accounts, such as individual retirement accounts (IRAs) and 401k plans, offer significant advantages for dividend investors. These accounts provide the opportunity to defer taxes on dividend income, allowing your investments to grow tax-free until withdrawal. By maximizing your contributions to these accounts, you can potentially reduce your overall tax burden and increase your after-tax returns. 3. Consider holding dividend-paying stocks in taxable accounts. While tax-advantaged accounts provide numerous benefits, there may be instances where holding dividend-paying stocks in a taxable account can be advantageous. This is especially true if you have already maximized your contributions to tax-advantaged accounts or if you anticipate needing the income generated by your dividend investments in the near term. Holding these stocks in taxable accounts can provide greater flexibility in accessing the dividends while potentially allowing for tax deductions, such as capital losses. 4. Be mindful of the holding period. As mentioned earlier, the tax treatment of dividends can vary based on the length of time the investment was held. Some countries offer tax advantages for long-term investors, often referred to as capital gains tax rates. By holding an investment for a specified period, you may qualify for a lower tax rate on any dividends received. Consider this factor when evaluating your investment strategy and the potential tax impact. Conclusion. Understanding dividend taxation is crucial for maximizing your overall returns as a dividend investor. By familiarizing yourself with the specific tax rules and rates that apply to your situation, you can make informed investment decisions and employ tax-efficient strategies to minimize your tax liability. Working with a tax professional to navigate the complexities of dividend taxation can provide valuable guidance and ultimately help you optimize your dividend returns. 8.2 Dividend Tax Rates. When investing in dividends, it is essential to understand the implications of dividend taxes. The tax rates applied to dividends can vary depending on several factors, including your income level, the type of dividend received, and your tax filing status. In this section, we will explore the different dividend tax rates and how they can affect your overall dividend returns. Understanding dividend taxation. Dividend taxation refers to the taxes imposed on the dividends received from investments. Dividends are generally classified as ordinary dividends or qualified dividends, and each type is subject to different tax rates. Ordinary dividends are typically taxed at your ordinary income tax rate. These dividends are paid by corporations from their earnings and profits and are subject to regular income tax rates. On the other hand, qualified dividends are subject to lower tax rates. To qualify for this favorable tax treatment, dividends must meet specific IRS criteria, such as being paid by a U.S. corporation or qualified foreign corporation and meeting specific holding period requirements. Qualified dividends are taxed at a maximum rate of 20% for most individuals in the highest tax brackets. It's important to note that not all dividends are considered qualified. Dividends received from real estate investment trusts, REITs, master limited partnerships, MLPs, and tax-exempt organizations are generally treated as ordinary dividends and subject to ordinary income tax rates. Dividend tax rates for individuals. The dividend tax rates for individuals are based on their taxable income and tax filing status. As of the most recent tax year, the dividend tax rates for individuals are as follows. For taxpayers in the 10% and 12% income tax brackets, qualified dividends are tax-free. For taxpayers in the 22%, 24%, 32%, 35%, or 37% income tax brackets, qualified dividends are taxed at a maximum rate of 20%. Ordinary dividends are subject to ordinary income tax rates, which range from 10% to 37% depending on the tax bracket. It's important to note that individuals with higher incomes may also be subject to an additional 3.8% net investment income tax (NIIT) on their dividends and other investment income if their modified adjusted gross income exceeds certain thresholds. Dividend tax rates for married couples filing jointly. For married couples filing jointly, the dividend tax rates are generally based on their combined taxable income. The rates are as follows. For couples in the 10% and 12% income tax brackets, qualified dividends are tax-free. For couples in the 22%, 24%, 32%, 35%, or 37% income tax brackets, qualified dividends are taxed at a maximum rate of 20%. Ordinary dividends are subject to ordinary income tax rates, which range from 10% to 37% depending on the tax bracket. Similar to individuals, married couples with higher incomes may also be subject to the additional 3.8% net investment income tax (NIIT) on their dividends if their modified adjusted gross income exceeds certain thresholds. Dividend tax rates for tax-exempt entities. Tax-exempt entities, such as certain retirement accounts or charitable organizations, may be exempt from dividend taxes. However, it's important to consult with a tax professional to ensure compliance with any specific rules or regulations governing tax-exempt entities. Strategies for managing dividend taxation. While taxes are an important consideration when investing in dividends, there are strategies to help manage dividend taxation effectively. Tax-efficient investing. Consider investing in tax-efficient dividend assets such as index funds or ETFs that focus on minimizing taxable events. Holding dividends in tax-advantaged accounts. Consider holding dividend stocks or funds in tax-advantaged accounts like individual retirement accounts, IRAs, or 401k plans. This can help defer taxes on dividends until withdrawals are made. Tax loss harvesting. If you own dividend stocks that have experienced capital losses, you can strategically sell them to offset capital gains and potentially reduce your tax liability. Diversified tax exposure. Diversify your dividend investments across different tax categories, such as holding a mix of qualified dividends and tax-exempt dividends, to help manage overall tax liability. Consult with a tax professional. It's important to seek advice from a qualified tax professional who can provide personalized guidance based on your specific tax situation and investment goals. Understanding dividend tax rates and implementing tax-efficient strategies can help you maximize your dividend returns effectively. By carefully managing the tax implications, you can ensure that you make informed decisions while building and maintaining your dividend portfolio. 8.3 Qualified versus non-qualified dividends. When it comes to the taxation of dividends, it's important to understand the distinction between qualified and non-qualified dividends. These terms refer to how dividends are taxed at the federal level in the United States. The classification of a dividend as qualified or non-qualified can have significant implications for investors, affecting the tax rates they are subject to. In this section, we will delve deeper into the differences between qualified and non-qualified dividends and explore the tax implications of each. What are qualified dividends? Qualified dividends are dividends that meet certain criteria set by the Internal Revenue Service, IRS, in the United States. In order to be considered qualified, dividends must meet the holding period and character requirements. The holding period requirement states that the taxpayer must have held the stock for a minimum period of time. For most common stocks, this holding period is at least 61 days within a 121-day period, which includes the 60 days before the ex-dividend date. Additionally, the stock must be held as an investment and not through speculative or hedging activities. The tax rates for qualified dividends are generally lower than the rates for ordinary income. Currently, qualified dividends are taxed at the same rates as long-term capital gains. For most taxpayers, this results in a lower tax rate compared to their ordinary income tax rate. The tax rates for qualified dividends range from 0% for individuals in the lowest income tax bracket to a maximum rate of 20% for those in the highest tax bracket. The actual tax rate depends on the taxpayer's overall income and filing status. What are non-qualified dividends? On the other hand, non-qualified dividends do not meet the requirements set by the IRS to be classified as qualified dividends. This could be because the holding period requirement is not met or the dividends are from a specific type of investment that does not qualify for preferential tax treatment, such as real estate investment trusts, REITs, or certain foreign corporations. Non-qualified dividends are taxed at the taxpayer's ordinary income tax rates, which range from 10% to 37%, depending on their income and filing status. This means that non-qualified dividends are subject to the same tax rates as wages, salaries, and other types of ordinary income. The exact tax rate applied to non-qualified dividends depends on the individual taxpayer's overall income and the corresponding tax brackets. Tax implications and considerations. The tax implications of qualified and non-qualified dividends have a direct impact on an investor's after-tax returns. Maximizing after-tax returns is a crucial aspect of dividend investing, as it can significantly affect the compounding power of dividend reinvestment over the long term. Investors who receive qualified dividends enjoy tax advantages through lower tax rates. By paying lower taxes on their dividends, investors can potentially reinvest more of their income and allow the power of compounding to work its magic over time. On the other hand, investors who receive non-qualified dividends are subject to higher tax rates, which can reduce their ability to reinvest and compound their returns. It is important to note that the tax treatment of dividends can vary depending on the investor's country of residence and tax laws. Investors should consult with a tax professional or refer to their country's tax regulations to fully understand the tax implications of dividends in their specific situation. Strategies to optimize tax efficiency. Given the potential tax advantages of qualified dividends, investors may consider implementing strategies to optimize tax efficiency within their dividend portfolios. Here are a few strategies to consider. 1. Maximize qualified dividends. Investors can focus on investing in stocks that pay qualified dividends to take advantage of the lower tax rates. This can involve researching and identifying companies that consistently meet the criteria for qualified dividends. 2. Asset location strategies. Investors can optimize their tax efficiency by strategically locating their dividend-paying investments within different types of accounts. For example, holding dividend-paying stocks in tax-advantaged accounts such as individual retirement accounts (IRAs) or 401k plans can help defer taxes or provide tax-free growth on dividends until withdrawals are made in retirement. 3. Tax loss harvesting. Investors can strategically harvest tax losses by selling investments that have experienced losses to offset any capital gains and reduce their overall tax liability. By effectively managing their capital gains and losses, investors can mitigate the tax impact on their dividend income. 4. Utilize tax-efficient funds. Investors can consider investing in tax-efficient funds, such as index funds or ETFs, which tend to generate fewer taxable events compared to actively managed funds. This can help minimize the tax liability associated with dividends and capital gains distributions. 5. Gift and estate planning. Investors can explore gifting or transferring dividend-paying investments to family members or loved ones in lower tax brackets. This can potentially reduce the overall tax liability and allow for the compounding of returns in a more tax-efficient manner. These strategies are just a few examples of how investors can optimize their tax efficiency when it comes to qualified and non-qualified dividends. Each individual's tax situation is unique, so it's important to consult with a tax professional who can provide personalized advice based on specific circumstances. Conclusion. Understanding the distinction between qualified and non-qualified dividends is crucial for dividend investors looking to maximize their after-tax returns. Qualified dividends offer preferential tax treatment, allowing investors to potentially reinvest more income and take advantage of the power of compounding. On the other hand, non-qualified dividends are subject to higher ordinary income tax rates. By implementing tax-efficient strategies and considering the tax implications of dividends, investors can strive to optimize their dividend returns and enhance the long-term growth of their portfolios. 8.4 Tax-efficient dividend strategies. When it comes to investing and maximizing dividend returns, it is important to consider the tax implications of your investment decisions. By implementing tax-efficient strategies, you can minimize the impact of taxes on your dividends and potentially increase your overall returns. In this section, we will explore some effective tax-efficient dividend strategies that can help you optimize your investment portfolio. Understanding dividend taxation. Before diving into specific tax-efficient strategies, it is crucial to have a clear understanding of how dividends are taxed. In most countries, dividends are subject to taxation as ordinary income. However, the tax rates on dividends can vary depending on several factors, including your tax bracket and the type of dividends you receive. Taking advantage of tax-advantaged accounts. One of the most effective strategies for minimizing taxes on dividend income is to invest through tax-advantaged accounts such as an individual retirement account (IRA, 401k), or tax-free savings account (TFSA). These accounts offer tax advantages, such as tax-deferred or tax-free growth, allowing your dividend earnings to compound without being immediately subject to taxes. By making use of these accounts, you can potentially maximize your dividend returns over the long term. Focus on qualified dividends. Qualified dividends refer to dividends that meet certain criteria set by the tax authorities. These dividends are typically taxed at a lower rate than ordinary dividends. To qualify for this preferential tax treatment, the dividends must be paid by a U.S. corporation or a qualified foreign corporation. Additionally, the shareholder must satisfy specific holding period requirements. By focusing on investing in companies that pay qualified dividends, you can take advantage of the lower tax rates associated with these dividends. This can significantly reduce the tax burden on your dividend income and increase your after-tax returns. Asset location strategies. Another tax-efficient strategy involves optimizing the location of your dividend-paying assets within your investment portfolio. Certain types of investments, such as real estate investment trusts, REITs, and master limited partnerships, MLPs, are subject to higher tax rates due to their unique tax structures. To minimize the impact of taxes on these investments, it is advisable to hold them in tax-advantaged accounts whenever possible. By placing tax-inefficient investments in tax-advantaged accounts, you can shield them from higher tax liabilities and potentially enhance your after-tax returns. Conversely, holding tax-efficient investments, such as stocks that pay qualified dividends, in taxable accounts can take advantage of the lower tax rates associated with these assets. This approach allows you to maximize the tax benefits of your investments and increase your overall dividend returns. Tax loss harvesting. Tax loss harvesting is a strategy that involves selling investments that have experienced losses to offset capital gains and minimize tax liabilities. This strategy can be particularly useful for dividend investors who have accumulated capital gains from the sale of other investments. By strategically harvesting tax losses, you can reduce your taxable capital gains and potentially lower your overall tax burden on dividend income. However, it is important to note that tax loss harvesting should be done carefully to avoid violating the wash sale rule. According to this rule, if you sell a security at a loss and purchase a substantially identical security within 30 days before or after the sale, the loss may be disallowed for tax purposes. To effectively implement tax loss harvesting, consult with a tax professional or financial advisor who can guide you through the process and ensure compliance with tax regulations. Consider dividend ETFs. Investing in dividend-focused exchange-traded funds, ETFs, can be a tax-efficient strategy for dividend investors. Dividend ETFs pool together a diversified portfolio of dividend-paying stocks, providing investors with exposure to a range of dividend stocks in a single investment vehicle. By investing in dividend ETFs rather than individual dividend-paying stocks, you can potentially reduce the tax burden associated with buying and selling individual stocks. Since ETFs are structured differently than mutual funds, they are generally more tax-efficient. By minimizing turnover and utilizing in-kind redemption mechanisms, ETFs can avoid triggering significant taxable events for investors. Additionally, reinvested dividends within an ETF are generally only subject to taxes when the shares are sold, allowing for potential tax deferral and compounding of returns. Consult with a tax professional or financial advisor. Implementing tax-efficient dividend strategies can be complex, and the tax landscape is subject to change. Therefore, it is essential to consult with a tax professional or financial advisor who has expertise in dividend taxation and investment planning. They can help you navigate the intricacies of tax laws, identify the most effective strategies for your unique situation, and ensure compliance with tax regulations. By following tax-efficient dividend strategies and making informed investment decisions, you can optimize your dividend returns and potentially achieve your long-term financial goals. Remember to consider your individual circumstances and consult with professionals who can provide tailored advice suited to your specific needs. 9. Dividend risk and returns. 9.1 Assessing dividend risk. When it comes to investing in dividend-paying stocks, it is crucial to assess the potential risks associated with these investments. While dividends can provide a steady stream of income and long-term growth, there are several factors that can impact the sustainability and stability of dividend payments. By understanding these risks, investors can make informed decisions and effectively manage their dividend portfolios. Importance of assessing dividend risk. Assessing dividend risk is essential for investors who rely on dividend income to meet their financial goals. By evaluating the risk factors, investors can determine the likelihood of consistent dividend payments and potential fluctuations in earnings. This assessment helps investors avoid stocks with unsustainable dividends and reduce the potential for loss. Factors to consider in assessing dividend risk. 1. Dividend coverage ratio. The dividend coverage ratio measures the ratio of a company's earnings to its dividend payments. A high coverage ratio indicates that a company's earnings are sufficient to cover its dividend obligations, reducing the risk of dividend cuts or suspensions. On the other hand, a low coverage ratio suggests that the company may struggle to maintain its dividend payments, increasing the risk for investors. 2. Dividend history. Analyzing a company's dividend history provides valuable insights into its commitment to regular dividend payments. A consistent track record of increasing or maintaining dividend payments is indicative of a financially stable and reliable company. Conversely, a history of dividend cuts or suspensions may raise concerns about the company's financial health and its ability to sustain future dividend payments. 3. Financial health of the company. Evaluating the financial health of a company is crucial in assessing dividend risk. Factors such as revenue growth, profitability, debt levels, and cash flow stability can give investors a clear picture of the company's ability to generate and sustain dividend payments. A financially sound company with a strong balance sheet is more likely to weather economic downturns and continue paying dividends even in challenging times. 4. Industry and economic conditions. The industry and economic conditions can significantly impact a company's ability to maintain dividend payments. Industries that are highly cyclical or sensitive to changes in the economy may face challenges in generating consistent earnings, which could affect dividend sustainability. It is essential to consider the broader economic context and industry-specific factors when assessing dividend risk. 5. Regulatory and legal factors. Regulatory and legal factors can also influence dividend risk. Changes in tax laws and regulations related to dividend payments can impact a company's ability to maintain dividend levels. It is crucial to stay informed about any potential changes that may affect the taxation or regulation of dividends to accurately assess the associated risks. Mitigating dividend risk. While assessing dividend risk is important, investors can take steps to mitigate these risks and maximize the potential returns from their dividend investments. 1. Diversification. Diversifying your dividend portfolio across different sectors and industries can help reduce the impact of any individual stock or industry-specific risks. By spreading investments across various dividend-paying companies, investors can lessen the potential negative effects of any single company's dividend cuts or suspensions. 2. Fundamental analysis. Conducting thorough fundamental analysis on potential dividend investments is crucial. This analysis involves evaluating factors such as a company's financial statements, management team, competitive position, and growth prospects. By thoroughly researching and understanding the underlying fundamentals of a company, investors can make more informed decisions, reducing the risk of investing in companies with unstable dividends. 3. Regular portfolio monitoring. Monitoring the performance of your dividend portfolio on a regular basis helps identify any signs of potential dividend risk early on. By staying informed about market conditions, industry trends, and company-specific news, investors can make necessary adjustments to their portfolios to mitigate risk and seize opportunities. 4. Risk management strategies. Implementing risk management strategies, such as setting stop-loss orders or trailing stop orders, can help protect dividend investments from significant losses. These strategies automatically trigger a sale if a stock's price falls below a certain threshold, limiting potential losses and preserving capital. 5. Professional advice. Seeking professional advice from financial advisors or investment managers who specialize in dividend investing can provide valuable insights and guidance. These professionals can help assess dividend risk, recommend appropriate dividend-paying stocks, and offer personalized strategies based on individual investment goals and risk tolerance. Conclusion. Assessing dividend risk is a critical aspect of dividend investing. By considering factors such as the dividend coverage ratio, dividend history, financial health of the company, industry and economic conditions, and regulatory factors, investors can make sound investment decisions and mitigate potential risks. By implementing diversification, conducting thorough fundamental analysis, regularly monitoring portfolios, managing risk effectively, and seeking professional advice, investors can maximize dividend returns while minimizing the associated risks. 9.2 Dividend sustainability. One of the key factors to consider when building a dividend portfolio is the sustainability of the dividends being offered by the companies in which you invest. Dividend sustainability refers to the ability of a company to maintain and grow its dividend payments over time. It is important to assess the sustainability of dividends because unreliable or unsustainable dividends can significantly impact the returns of your portfolio. When evaluating the sustainability of dividends, there are several factors to consider. 1. Dividend history and track record. A company's dividend history and track record is a valuable indicator of its commitment to dividend payments. Look for companies that have a consistent track record of paying dividends and increasing them over time. A long history of uninterrupted dividend payments indicates financial stability and a commitment to shareholders. 2. Earnings and cash flow. The sustainability of dividends is directly linked to the company's earnings and cash flow. A company must generate sufficient earnings and cash flow to cover its dividend payments. Analyze the company's financial statements to assess its profitability and cash flow generation abilities. Ensure that the dividends being paid are well supported by the company's financial health. 3. Dividend payout ratio. The dividend payout ratio is a useful metric that indicates the portion of earnings that a company distributes as dividends. It is calculated by dividing the dividends paid by the company's earnings. A higher payout ratio may indicate a greater risk to dividend sustainability, as the company is using a larger portion of its earnings to pay dividends. A lower payout ratio, on the other hand, indicates that the company retains a larger portion of its earnings for reinvestment or other uses, increasing the likelihood of sustainable dividend payments. 4. Industry and competitive landscape. Consider the industry in which the company operates and its competitive positioning. Industries with stable and predictable cash flows are generally more capable of sustaining dividends. Companies operating in highly competitive and cyclical industries may face challenges in maintaining consistent dividend payments. Carefully assess the industry trends and competitive dynamics to gauge the sustainability of dividends in the long run. 5. Debt levels and financial health. A company's debt levels and overall financial health are crucial factors in assessing dividend sustainability. High levels of debt can limit a company's ability to pay dividends, as debt obligations must be met first. Look for companies with manageable debt levels and strong balance sheets. A healthy financial position enables a company to navigate economic downturns and continue providing stable dividends to shareholders. 6. Dividend coverage ratio. The dividend coverage ratio is a measure of a company's ability to cover its dividend payments with earnings. It is calculated by dividing earnings per share (EPS) by the dividend per share. A ratio greater than 1 indicates that the company's earnings are sufficient to cover the dividend payments. A ratio below 1 suggests that the company may be relying on other sources, such as debt or cash reserves, to finance dividend payments. A higher dividend coverage ratio indicates a greater likelihood of sustainable dividend payments. 7. Company strategy and future outlook. Consider the company's strategy and future growth prospects when assessing dividend sustainability. Companies with a clear plan for growth and a strong competitive position are more likely to generate the earnings and cash flow needed to sustain and grow dividends. Evaluate the company's long-term prospects and ensure that the dividend payments align with its growth trajectory. 8. Economic and market conditions. The economic and market conditions can have a significant impact on a company's dividend sustainability. A company operating in a recession-prone industry may face challenges during economic downturns, leading to dividend cuts or suspensions. Analyze the company's resilience in different economic scenarios and assess the potential impact of market conditions on its ability to sustain dividends. By considering these factors, investors can evaluate the sustainability of dividends and make informed decisions when selecting dividend-paying stocks for their portfolio. Remember that investing in dividend-paying companies with sustainable dividends can provide a stable and growing stream of income, helping to maximize your dividend returns over time. 9.3 Economic cycles and dividend returns. Economic cycles play a significant role in shaping dividend returns. Understanding the impact of economic cycles on dividend investing is crucial for maximizing dividend returns and managing risks effectively. In this section, we will explore how economic cycles influence dividend returns and discuss strategies to navigate through different stages of the economic cycle. Economic cycles and dividend investing. Economic cycles consist of various phases, including expansion, peak, contraction, and trough. These cycles are driven by factors such as GDP growth, interest rates, inflation, and overall market conditions. Each phase of the economic cycle presents unique opportunities and challenges for dividend investors. Expansion. During the expansion phase, the economy is growing, and corporate earnings tend to improve. This often results in higher dividend payouts as companies generate more profits. Dividend investors can benefit from both capital appreciation and increasing dividend income during this phase. It is important to focus on companies with a history of sustained dividend growth and strong fundamentals to capture maximum returns. Peak. The peak phase occurs when the economy reaches its highest point before entering a contraction phase. Dividend returns may continue to increase, but the rate of growth might slow down. Companies may become more cautious with dividend increases as economic indicators show signs of slowing. Investors should closely monitor any potential changes in corporate earnings and cash flows during this phase. Contraction. The contraction phase, also known as a recession, is characterized by a decline in economic activity. During this phase, companies may face financial difficulties, which could result in dividend cuts or suspensions. Dividend investors need to be particularly cautious during this phase and focus on companies with strong balance sheets, stable cash flows, and a history of withstanding economic downturns. Trough. The trough phase represents the bottom of the economic cycle, where economic activity begins to recover. Dividend returns may start to stabilize during this phase, offering opportunities for investors to identify undervalued dividend stocks. It is crucial to conduct thorough research and analysis to identify financially strong companies capable of sustaining their dividend payments. Strategies for managing dividend investing during economic cycles. While economic cycles can be challenging for dividend investors, there are several strategies that can help navigate the ups and downs of the market and maximize dividend returns. Diversification. Diversifying your dividend portfolio across different sectors and industries can help reduce the impact of economic cycles on your overall returns. By investing in companies from different sectors, you can mitigate the risk of significant losses during economic downturns. Focus on quality. During periods of economic uncertainty, it becomes even more critical to focus on high-quality dividend-paying companies. Look for well-established companies with strong balance sheets, consistent cash flows, and a history of increasing dividends. These companies are more likely to navigate through economic cycles successfully and continue paying dividends even in challenging times. Dividend growth investing. Dividend growth investing focuses on investing in companies that consistently increase their dividend payouts over time. This strategy aims to capture both increasing dividend income and potential capital appreciation. During economic expansions, companies with a track record of dividend growth often outperform their peers. Rebalance regularly. Regularly reviewing and rebalancing your dividend portfolio during different phases of the economic cycle is crucial. Adjusting your portfolio allocations based on evolving market conditions and economic indicators can help optimize dividend returns and manage risk effectively. Long-term perspective. Dividend investing is a long-term strategy. While economic cycles can impact short-term returns, it is important to maintain a long-term perspective and focus on the potential for compounding dividend income over time. By reinvesting dividends and staying invested through different economic cycles, investors can benefit from the power of compounding. Monitoring and research. Stay informed about economic indicators, market trends, and the financial performance of the companies in your dividend portfolio. Regularly monitor the company's dividend payout ratios, cash flows, and overall financial health to make informed investment decisions. Conclusion. Economic cycles have a significant impact on dividend returns. By understanding the different phases of the economic cycle and implementing appropriate strategies, investors can maximize their dividend returns and manage risks effectively. Diversification, focusing on quality companies, dividend growth investing, regular rebalancing, maintaining a long-term perspective, and conducting thorough research are key factors in successfully navigating economic cycles and harnessing the power of compounding dividend returns. 9.4 Impact of market conditions on dividends. When investing in dividend stocks, it is crucial to consider the impact of market conditions on dividend returns. Market conditions can affect the performance and stability of dividend-paying companies, as well as the overall dividend yield in the market. In this section, we will explore how different market conditions can influence dividends and what investors should consider when building and managing their dividend portfolios. Market volatility and dividends. One of the key factors that can influence dividend payments is market volatility. During periods of high market volatility, companies may experience significant price fluctuations, which can impact their ability to distribute dividends. Companies that face financial challenges or economic uncertainty may choose to reduce or even eliminate their dividend payments to conserve cash and maintain financial stability. When market conditions are uncertain or negative, companies may face declining revenues, rising costs, or reduced profitability. In such situations, management teams often prioritize strengthening their balance sheets or reinvesting capital in the business rather than distributing dividends. This is especially true for cyclical industries that are more sensitive to economic cycles, such as energy or manufacturing. However, it's important to note that not all companies react to market volatility in the same way. Some companies with strong financial positions and stable cash flows may continue to pay dividends even during challenging market conditions. These companies are often considered defensive stocks and are sought after by income-seeking investors precisely because of their ability to maintain consistent dividends regardless of market fluctuations. Interest rates and dividends. Interest rates also play a significant role in influencing dividend yields. When interest rates are low, such as during periods of monetary easing by central banks, investors seeking income may turn to dividend-paying stocks as an alternative to fixed-income investments that offer lower yields. This increased demand for dividend stocks can drive up their prices and lead to lower dividend yields. Conversely, when interest rates rise, dividend stocks may become less attractive relative to fixed-income investments. As fixed-income investments provide higher yields, income-seeking investors may shift their investments away from dividend stocks, resulting in downward pressure on their prices and potentially increasing the dividend yields on those stocks. Therefore, the relationship between interest rates and dividend yields is inversely correlated in most cases. Economic conditions and dividend growth. Economic conditions can also significantly impact dividend growth. During periods of economic expansion, companies often experience increased revenues and profits, enabling them to increase their dividend payments. Strong economic conditions typically lead to higher consumer spending, business investments, and corporate profitability, all of which contribute to the growth of dividends. In contrast, during economic downturns or recessions, companies may face declining revenues, lower profits, and reduced cash flows. In such situations, companies may choose to reduce or halt dividend payments to preserve capital. This is particularly relevant for companies operating in industries that are negatively affected by economic downturns, such as retail, hospitality, or travel. However, it's worth noting that some companies have a long history of consistently increasing their dividends year after year, irrespective of economic conditions. These companies, commonly referred to as dividend aristocrats or dividend kings, demonstrate their ability to generate consistent cash flows and maintain stable dividend growth even during challenging economic times. Investors seeking reliable dividend growth often favor these companies for their resilience and ability to weather economic storms. Global and geopolitical factors. Dividend investors should also be aware of the impact of global and geopolitical factors on dividend returns. Events such as political instability, trade disputes, or regulatory changes can introduce uncertainty and volatility into financial markets. Companies that operate in international markets or have significant exposure to global trade may experience disruptions in their business operations or face increased costs, affecting their ability to pay dividends. Geopolitical factors, such as changes in government policies or regulations, can also influence dividend payments. Government actions, such as tax reforms, changes in dividend tax rates, or shifts in corporate governance standards can directly impact dividend policies and the distribution of profits to shareholders. Investors should stay informed about geopolitical events and their potential implications on the companies they invest in. Mitigating the impact of market conditions. While market conditions can have a significant impact on dividend returns, there are strategies that investors can employ to mitigate these effects. Diversification. By diversifying their dividend portfolios across different sectors and regions, investors can reduce their exposure to specific market risks. Diversification helps spread the risk and insulates the portfolio from the performance of individual stocks or sectors. Focus on quality. Investing in high-quality companies with strong financial positions, stable cash flows, and proven track records of dividend payments can provide a level of resilience against market volatility. These companies are more likely to weather economic downturns and continue paying dividends. Long-term approach. Taking a long-term investment perspective allows investors to ride out short-term market fluctuations. Dividends compound over time, and by staying invested for the long haul, investors can benefit from the power of compounding and realize the full potential of dividend returns. Continuous monitoring. Regularly monitoring the performance and financial health of dividend-paying companies is essential. By staying abreast of company news, earnings reports, and market trends, investors can quickly identify any changes in dividend policies and adjust their portfolios accordingly. In conclusion, market conditions can significantly impact dividend returns. Understanding how different market factors influence dividends is crucial for dividend investors to build resilient and profitable portfolios. By applying strategies to mitigate market risks and focusing on high-quality companies, investors can improve their chances of maximizing dividend returns over the long term. 10. Dividend reinvestment tools and platforms. 10.1 Online brokers and dividend reinvestment. Online brokers have revolutionized the way investors manage their portfolios and engage in dividend reinvestment. These platforms provide a convenient and efficient way to access a wide range of investment options and execute trades. When it comes to dividend investing, online brokers offer several key features and tools that can help maximize dividend returns. Direct Dividend Reinvestment Plans (DRIPs). One of the primary advantages of online brokers is the availability of direct dividend reinvestment plans (DRIPs). DRIPs allow investors to automatically reinvest their dividends back into the underlying dividend-paying stocks without incurring additional fees. This feature enables the power of compounding to work its magic by reinvesting dividends and purchasing additional shares. By reinvesting dividends through DRIPs, investors can potentially accumulate more shares over time, thereby increasing their dividend income in a compounding fashion. Dividend growth stocks often provide the best opportunities for DRIP investors because they tend to increase their dividends regularly, allowing for an even greater compounding effect. Portfolio customization and diversification. Online brokers provide investors with a wide range of options to diversify their dividend portfolios. Through these platforms, investors can easily customize their portfolio by selecting dividend-paying stocks across various sectors, industries, and market capitalizations. Diversification is crucial for managing risk and ensuring a steady stream of dividends even in times of market volatility. Moreover, online brokers offer access to a diverse range of investment vehicles such as exchange-traded funds, ETFs, and mutual funds that focus specifically on dividend income. These investment options provide a convenient way to gain exposure to a basket of dividend-paying stocks across multiple sectors, further diversifying the dividend portfolio. Real-time dividend reporting and tracking. Online brokers offer real-time reporting and tracking features that enable investors to stay on top of their dividend portfolio performance. These platforms provide detailed information about dividend payouts, dividend yield, dividend growth, and dividend payments history for each stock in the portfolio. Investors can easily analyze the income generated from dividends and make informed decisions regarding reinvestment and portfolio management. By monitoring dividend performance, investors can identify any potential issues with dividend sustainability or changes in dividend policies that may impact their returns. Real-time reporting allows investors to quickly react to changes and adjust their portfolio accordingly. Research and analytical tools. Online brokers often provide a suite of research and analytical tools that can assist investors in making informed decisions about dividend stocks. These tools typically include fundamental analysis tools, such as financial statement analysis, dividend history charts, and stock screener functionalities. Investors can use these tools to screen for high-quality dividend-paying stocks based on certain criteria, such as dividend yield, dividend growth rate, and dividend payout ratio. By conducting thorough research and analysis, investors can identify companies with a strong track record of dividend growth and stability, increasing the likelihood of maximizing dividend returns. Education and support. Another significant benefit of using online brokers for dividend reinvestment is the availability of educational resources and customer support. Many online brokerages offer educational materials, including articles, videos, webinars, and tutorials, that can help investors build their knowledge and understanding of dividend investing strategies. In addition, customer support teams are available to assist investors with any questions, concerns, or technical issues related to dividend reinvestment. These resources can be valuable for both experienced investors seeking to enhance their dividend portfolio and novice investors looking to enter the world of dividend investing. Considerations for choosing an online broker. When selecting an online broker for dividend reinvestment, it is important to evaluate several factors. These factors include commission fees, account minimums, available investment options, research tools, customer support, and the overall user experience of the platform. Investors should also consider the reputation and reliability of the online broker to ensure the safety of their investments and the accuracy of dividend payments. Reading reviews and conducting thorough research can help in selecting a reputable and trustworthy online broker that meets individual investment needs and preferences. In conclusion, online brokers provide a powerful platform for maximizing dividend returns through features such as direct dividend reinvestment plans, portfolio customization and diversification, real-time dividend reporting and tracking, research and analytical tools, and educational resources. By utilizing these tools and services, investors can optimize their dividend reinvestment strategies and unlock the full potential of compounding returns. 10.2 Dividend Tracking Apps and Software. Tracking your dividends is crucial for maximizing returns and managing your dividend portfolio effectively. Fortunately, there are numerous dividend tracking apps and software available that can simplify this process and provide you with valuable insights and data to make informed investment decisions. In this section, we will explore the benefits of using dividend tracking apps and software, discuss some popular options, and provide tips for choosing the right tool for your needs. Benefits of dividend tracking apps and software. Dividend tracking apps and software offer several advantages for dividend investors. Here are some key benefits. 1. Automate dividend tracking. Dividend tracking apps and software automate the process of recording and tracking dividend payments. Instead of manually entering data into spreadsheets or keeping track of paper statements, these tools fetch the necessary information from brokerage accounts and financial institutions, saving you time and effort. 2. Consolidate portfolio information. With dividend tracking apps, you can consolidate all your dividend-paying investments in one place. These tools gather dividend data from various sources, including brokerage accounts, mutual funds, and exchange-traded funds (ETFs), and provide a comprehensive view of your dividend income. 3. Real-time updates. Dividend tracking apps provide real-time updates on dividend payments, ensuring you have the most up-to-date information on your investments. You can receive notifications when dividends are paid, track ex-dividend dates, and monitor changes in dividend rates. 4. Portfolio analysis. Many dividend tracking apps offer portfolio analysis features, allowing you to assess the performance of your dividend portfolio. These tools provide insights into dividend yields, dividend growth rates, and total returns, enabling you to evaluate the effectiveness of your dividend investment strategy. 5. Tax reporting. Managing dividend taxes can be a complex task. Dividend tracking apps help simplify this process by generating tax reports and providing detailed information on qualified dividends, non-qualified dividends, and tax obligations. This feature can save you time and help you comply with tax regulations. Dividend tracking apps and software options. Here are a few popular dividend tracking apps and software options available. 1. Personal Capital. Personal Capital is a comprehensive financial management platform that offers dividend tracking capabilities. It provides a holistic view of your investments, including dividend income, and allows you to track your portfolio performance. Personal Capital also integrates with several brokerage accounts and financial institutions, making it easy to gather dividend information. 2. Seeking Alpha. Seeking Alpha is a popular investment research platform that also offers dividend tracking features. It provides real-time dividend news, analysis, and insights on individual stocks, as well as dividend payment notifications. Seeking Alpha allows you to create watchlists and track the dividends of specific companies. 3. Dividend.com. Dividend.com is a dividend-focused website that offers a range of dividend investing resources. It provides a dividend tracker tool that allows you to monitor your dividend income, dividend growth, and dividend payment dates. Dividend.com also offers dividend stock ratings, dividend news, and educational content for dividend investors. 4. Atom Finance. Atom Finance is an investment tracking and portfolio management platform that includes dividend tracking functionality. It provides real-time updates on dividend payments, dividend yield calculations, and dividend growth rates. Atom Finance also offers other investment analysis tools, such as financial statement analysis and valuation metrics. Tips for choosing the right dividend tracking app or software. When selecting a dividend tracking app or software, consider the following factors. 1. User-friendly interface. Choose a tool with a user-friendly interface that is easy to navigate and provides a seamless experience. Look for apps or software that have intuitive design and offer clear visuals to help you understand and interpret the data. 2. Integration with brokerage accounts. Ensure that the tool integrates with your brokerage accounts or financial institutions to automatically fetch dividend data. This integration simplifies the process of tracking dividends and reduces the need for manual data entry. 3. Customization options. Look for apps or software that allow you to customize and tailor the information you want to track. The ability to personalize your dividend tracking dashboard can enhance your user experience and provide you with the data that is most relevant to your investment strategy. 4. Security. Choose a tool that prioritizes data security and provides encryption for your financial information. Look for apps or software that follow industry standard security practices and have a good reputation for safeguarding user data. 5. Additional features. Consider the additional features offered by the dividend tracking app or software. Some tools provide access to a community of dividend investors, research reports, stock ratings, and educational resources. Evaluate these features based on your specific needs and preferences. In conclusion, dividend tracking apps and software play a vital role in maximizing dividend returns and managing your dividend portfolio effectively. These tools automate dividend tracking, consolidate portfolio information, provide real-time updates, and offer portfolio analysis and tax reporting capabilities. With the plethora of options available, choose a dividend tracking app or software that is user-friendly, integrates with your accounts, allows customization, prioritizes security, and offers additional features that align with your investment goals. By leveraging the power of technology, you can optimize your dividend investing strategy and make informed decisions to enhance your long-term returns. 10.3 Dividend Screeners and Analytical Tools. When it comes to maximizing dividend returns, having access to the right information and tools can make all the difference. In this section, we will explore dividend screeners and analytical tools that can help you identify and evaluate dividend stocks to build a successful dividend portfolio. Dividend screeners. Dividend screeners are powerful tools that allow you to filter through a vast universe of stocks and focus on those that meet your specific dividend criteria. These tools enable you to search for stocks based on various dividend-related parameters, such as dividend yield, dividend growth rate, payout ratio, and dividend stability. By using a dividend screener, you can save time and effort by narrowing down your options to a list of potential dividend stocks that align with your investment goals. These screeners often provide customizable filters, allowing you to set specific thresholds for dividend metrics that you consider crucial. For example, if you are interested in high dividend yield stocks, you can set a minimum yield requirement. By doing so, the screener will only display stocks that meet or exceed your specified minimum yield threshold. This serves as an effective starting point for further analysis and evaluation. Dividend screeners also enable you to sort the results based on different criteria, such as dividend yield, dividend growth rate, or market capitalization. This feature can help you identify the highest yielding stocks, the fastest growing dividend stocks, or the largest dividend paying companies. These tools provide valuable data and insights about dividend stocks, including historical dividend payments, dividend growth trends, and company financials. By leveraging this information, you can make informed decisions and select stocks that align with your dividend investing strategy. Analytical tools. In addition to dividend screeners, analytical tools play a vital role in maximizing dividend returns. These tools provide in-depth analysis of dividend stocks, allowing you to assess their financial health, dividend sustainability, and growth potential. One popular analytical tool for dividend investors is the Dividend Discount Model (DDM). The DDM is a valuation method that estimates the intrinsic value of a stock based on its expected future dividends. By using this model, you can determine whether a stock is undervalued or overvalued, helping you make investment decisions accordingly. Another essential analytical tool is the Dividend Growth Rate Calculator. This tool allows you to calculate the average annual growth rate of a stock's dividend over a specific period. By analyzing the dividend growth rate, you can assess the company's ability to increase its dividend payments consistently. Analytical tools also provide access to financial ratios and metrics that can enhance your understanding of dividend stocks. Some key metrics to consider include the dividend payout ratio, which measures the portion of earnings paid out as dividends, and the dividend coverage ratio, which assesses a company's capacity to sustain its dividend payments. Furthermore, dividend analytical tools often provide interactive charts and visualizations that help you track dividend performance and compare multiple stocks. These charts can display important data, such as dividend history, dividend growth trends, and dividend reinvestment impact, giving you a comprehensive overview of a stock's dividend characteristics. Integration with online brokers and portfolios. Many dividend screeners and analytical tools integrate seamlessly with online brokerage platforms and portfolio management tools. This integration enables you to streamline your dividend investing process by accessing dividend data and analysis directly from your brokerage account or portfolio dashboard. By connecting your brokerage account, you can receive real-time dividend alerts and notifications for the stocks in your portfolio. These alerts can inform you of upcoming dividend payments, dividend changes, or any significant news that may impact your dividend income. Moreover, some dividend screeners and analytical tools offer portfolio tracking features, allowing you to monitor the performance of your dividend investments in one central location. This feature provides insights into your overall dividend income, dividend growth, and diversification across different sectors or asset classes. Conclusion. Dividend screeners and analytical tools are essential resources for dividend investors seeking to maximize their returns. These tools enable you to filter through stocks based on specific dividend criteria, save time and effort, and make informed investment decisions. By leveraging the power of dividend screeners, you can identify potential dividend stocks that meet your desired investment parameters. The integration with analytical tools further allows you to analyze the financial health, dividend sustainability, and growth potential of these stocks. Ultimately, the use of dividend screeners and analytical tools, combined with a solid understanding of dividend investing principles, can help you build a successful dividend portfolio and harness the power of compounding to generate significant long-term returns. 10.4 Financial websites for dividend investors. When it comes to maximizing dividend returns, staying informed is key. As a dividend investor, you need access to reliable financial data and tools that can help you make informed decisions about your portfolio. Fortunately, there are several financial websites that cater specifically to dividend investors and provide a wealth of information and resources. In this section, we will explore some of the top financial websites that can be valuable assets in your dividend investing journey. 1. Seeking Alpha. Seeking Alpha is a popular online platform that offers a wide range of financial data, news, analysis, and opinions from experts and investors around the world. It covers a variety of investment topics, including dividend stocks. Seeking Alpha has a dedicated dividend section where you can find articles, research reports, and investment ideas related to dividend investing. The platform also allows you to create a watchlist of dividend stocks and provides real-time stock quotes and charts. 2. Yahoo Finance. Yahoo Finance is another widely used financial website that provides comprehensive market data, news, and analysis. It offers a dedicated section for dividend investing, where you can find information on dividend stocks, upcoming dividend payments, and historical dividend data. Yahoo Finance also allows you to create a personalized portfolio and track the performance of your dividend stocks. The website provides a wealth of data such as dividend yield, dividend payout ratio, and dividend history for individual stocks. 3. Dividend.com. As the name suggests, Dividend.com focuses solely on dividend investing. The website offers a variety of tools and resources to help dividend investors screen, analyze, and track dividend stocks. Dividend.com provides a dividend screener that allows you to filter stocks based on various dividend-related criteria such as dividend yield, dividend growth rate, and payout ratio. The platform also offers in-depth analysis and articles on dividend stocks, as well as a dividend calendar that shows upcoming dividend payments. 4. Dividend Channel. Dividend Channel is a website that specializes in dividend stock analysis. It provides investors with a wide range of tools and resources to evaluate dividend stocks and make informed investment decisions. Dividend Channel offers a dividend stock screener that allows you to filter stocks based on dividend yield, dividend growth, and other criteria. The website also provides a dividend history database, where you can track the dividend payment history of individual stocks. Additionally, Dividend Channel offers a variety of educational resources, including videos and articles on dividend investing strategies. 5. Dividend Yield Hunter. Dividend Yield Hunter is a website that focuses on high-yield dividend stocks. It provides a curated list of dividend stocks with attractive dividend yields. The website offers a wide range of resources for dividend investors, including articles, investment guides, and a dividend stock newsletter. Dividend Yield Hunter also provides a dividend reinvestment calculator, which can help you estimate the growth of your portfolio by reinvesting dividends. 6. Simply Safe Dividends. Simply Safe Dividends is a financial website that aims to provide dividend investors with safe and reliable income-generating investments. The platform offers a dividend safety score, which assesses the financial health and stability of dividend-paying companies. Simply Safe Dividends also provides a dividend portfolio tracker, where you can input your dividend stocks and track their performance. Additionally, the website offers educational resources, such as dividend investing guides and articles on risk management. These financial websites are just a few examples of the resources available to dividend investors. Each platform offers unique features and tools that can assist you in maximizing your dividend returns. Remember to use these websites as a complement to your own research and analysis, as no single platform can guarantee investment success. By leveraging the information and resources provided by these websites, you can gain valuable insights and make well-informed decisions to grow your dividend portfolio. 11. Dividend Investing Strategies. 11.1 Value Dividend Investing Strategy. The value dividend investing strategy focuses on identifying undervalued dividend stocks that have the potential for both capital appreciation and consistent dividend payments. This strategy involves searching for quality companies that are trading at a discount to their intrinsic value and offer attractive dividend yields. Key principles of value dividend investing. Focus on intrinsic value. The cornerstone of the value dividend investing strategy is determining the intrinsic value of a company. Intrinsic value represents the true worth of a company based on its fundamental metrics, cash flows, and growth prospects. By identifying companies whose current stock price is below their intrinsic value, investors can potentially achieve higher returns. Consider dividend yield. Dividend yield is an important factor in the value dividend investing strategy. Dividend yield is calculated by dividing the annual dividend per share by the stock price. A higher dividend yield signifies a higher income stream relative to the investment. However, it is important to consider other factors such as the sustainability and growth potential of the dividend. Analyze fundamentals. When applying the value dividend investing strategy, it is crucial to thoroughly analyze the fundamentals of a company. This includes assessing its financial health, such as the stability of earnings, cash flows, debt levels, and payout ratios. Evaluating the company's competitive position, industry trends, and management team can also provide valuable insights. Look for undervalued companies. The focus of value dividend investing is to find companies that are currently undervalued by the market. This can be done by comparing a company's current stock price to its intrinsic value, using valuation techniques such as price-to-earnings (PE) ratios, price-to-book (PE) ratios, or discounted cash flow (DCF) analysis. Identifying companies with a margin of safety, where the stock price is significantly below the calculated intrinsic value, offers the potential for capital appreciation. Benefits of value dividend investing strategy. Potential for higher returns. By investing in undervalued dividend stocks, the value dividend investing strategy aims to generate higher returns as the market eventually corrects the price to reflect the intrinsic value. As the stock price appreciates, investors can benefit from capital appreciation in addition to receiving regular dividend payments. Income generation. Dividend stocks, especially those with higher dividend yields, can provide a steady income stream. Companies that have a history of consistently increasing their dividends over time can be particularly attractive for investors seeking a reliable income source. Risk mitigation. The value dividend investing strategy focuses on investing in companies with sound fundamentals and a margin of safety. The careful analysis of a company's financial health and industry position helps to identify potential risks and minimize the chances of investing in companies with unstable dividends or poor growth prospects. Long-term wealth accumulation. The compounding effect of reinvesting dividends from undervalued dividend stocks can significantly enhance long-term wealth accumulation. By reinvesting dividends received, investors can purchase additional shares and potentially benefit from both capital appreciation and increased dividend payments over time. Implementation of value dividend investing strategy. Screening for undervalued dividend stocks. Investors can utilize various financial tools and screening techniques to identify undervalued dividend stocks. These tools can help filter companies based on fundamental metrics such as P/E ratios, P/B ratios, dividend payout ratios, and dividend growth rates. By focusing on companies with favorable valuation metrics compared to their industry peers, investors can create a short list of potential candidates for further analysis. In-depth fundamental analysis. Once the initial screening is complete, investors should conduct a thorough analysis of the shortlisted companies. This involves assessing financial statements, earnings growth potential, competitive advantages, and industry dynamics. An understanding of the company's long-term prospects and its ability to sustain and grow dividends is essential in selecting the most suitable investments. Diversify the portfolio. As with any investment strategy, diversification is key. By spreading investments across different companies and sectors, investors can reduce risk and minimize the impact of individual stock performance on the overall portfolio. Diversification provides exposure to various dividend-paying opportunities, ensuring a stable income stream and potential for capital appreciation. Regular monitoring and portfolio adjustments. A value dividend investing strategy requires ongoing monitoring of the portfolio. Regular reviews of the fundamental factors impacting each investment, the overall market conditions, and any changes in the company's dividend policy are essential. As market conditions change, adjustments to the portfolio may be necessary to optimize returns and mitigate risks. The value dividend investing strategy offers investors the opportunity to benefit from both capital appreciation and consistent income through dividend payments. By focusing on undervalued stocks with strong fundamentals and attractive dividend yields, investors can potentially achieve higher returns and build long-term wealth. However, it is crucial to conduct thorough research and continuously monitor the portfolio to ensure the investments remain aligned with the chosen investment strategy. 11.2 Growth Dividend Investing Strategy. The growth dividend investing strategy focuses on investing in companies that have a history of consistently increasing their dividend payments over time. This strategy aims to capture not only the income generated from dividends but also the potential for capital appreciation as the company grows. Understanding the growth dividend investing strategy. When implementing a growth dividend investing strategy, investors seek out companies that have a track record of increasing their dividends year after year. These companies are typically well established, financially sound, and have a proven history of generating consistent earnings and cash flow. By selecting companies with a strong commitment to dividend growth, investors can benefit from both the income provided by the dividends and the potential for the stock price to appreciate over time. Why choose the growth dividend investing strategy? The growth dividend investing strategy can be attractive to investors who are looking for a combination of income and capital appreciation. By focusing on companies that consistently increase their dividends, investors can benefit from a growing income stream over time. This can be particularly appealing for those investors who are seeking a reliable source of income, such as retirees. Furthermore, companies that consistently increase their dividends often do so because they are growing their businesses and generating higher profits. As a result, the stock price of these companies may also appreciate over time. This can provide investors with the potential for capital gains in addition to the income generated from the dividends. Selecting companies for the growth dividend investing strategy. When selecting companies for the growth dividend investing strategy, investors typically look for certain characteristics. These may include dividend growth history. Investors seek companies that have a track record of increasing their dividends over multiple years. The longer the history of consistent dividend growth, the more reliable the company's commitment to shareholder returns. Earnings and cash flow stability. Companies with stable earnings and cash flow are better positioned to continue increasing their dividends. Investors analyze financial statements and assess the company's ability to generate consistent profits. Industry and market prospects. Companies operating in industries with significant growth potential may have better opportunities to increase their dividends. Investors consider the company's strategic position within its industry and evaluate its growth prospects. Dividend payout ratio. The dividend payout ratio compares the dividends paid by a company to its earnings. A lower payout ratio indicates that the company retains a higher portion of its earnings for reinvestment, which can support future dividend growth. Benefits and risks of the growth dividend investing strategy. The growth dividend investing strategy offers several benefits for investors. Income growth. By focusing on companies with a history of increasing dividends, investors can potentially benefit from a growing income stream over time. This can be particularly advantageous for individuals seeking income in retirement or those who rely on dividends to cover their living expenses. Potential for capital appreciation. Companies that consistently raise their dividends often experience stock price appreciation over time. This can provide additional returns to investors through capital gains. Long-term wealth accumulation. Through compounding, reinvesting dividends from companies with a growth dividend strategy can accelerate wealth accumulation. Reinvesting dividends allows investors to purchase more shares, which in turn generate a higher income stream. However, there are also risks associated with the growth dividend investing strategy. Market volatility. The stock prices of companies can fluctuate due to market conditions, economic factors, or company-specific events. While dividend growth companies may be more stable than others, they are not immune to market volatility. Investors should be prepared for potential declines in stock prices. Dividend cuts or suspensions. Companies can face financial challenges that may result in a reduction or suspension of their dividends. Although companies with a long history of dividend growth are generally more reliable, unforeseen circumstances can impact their ability to maintain dividend increases. Limited diversification. Investing solely in companies with a growth dividend strategy may lead to an imbalance in a portfolio. Diversification across different sectors and asset classes is essential to manage risk effectively. Implementing the growth dividend investing strategy. To implement the growth dividend investing strategy, investors should conduct thorough research and analysis of the companies they are considering. Key steps include: identify dividend growth companies. Look for companies with a consistent track record of increasing dividends over time. Assess financial health. Analyze the company's financial statements, including earnings, cash flow, and debt levels, to evaluate its ability to sustain dividend growth. Evaluate industry and market prospects. Consider the company's industry outlook and its competitive position within it. Monitor your portfolio. Regularly review your holdings to ensure that the companies you invest in continue to meet your criteria for dividend growth. By following these steps, investors can build a portfolio that aims to generate both increasing income and potential capital appreciation over time. It's important to note that the growth dividend investing strategy requires a long-term perspective, as the benefits of dividend growth and capital appreciation often compound over years. In conclusion, the growth dividend investing strategy focuses on selecting companies with a track record of consistently increasing their dividends over time. By investing in these companies, investors aim to benefit from both the income generated by dividends and the potential for capital appreciation. However, it's essential to conduct thorough research and consider the associated risks before implementing this strategy. 11.3 Income Dividend Investing Strategy. The income dividend investing strategy is focused on generating a steady stream of income through dividend-paying stocks. While some investors primarily seek capital appreciation, income investors prioritize generating regular income from their investments. This strategy is particularly appealing to individuals who are looking for a consistent income stream to support their living expenses or to build wealth over the long term. Understanding the income dividend investing strategy. The income dividend strategy involves selecting dividend-paying stocks that offer a high dividend yield. Dividend yield is a ratio that measures the annual dividend income generated by a stock relative to its market price. Income investors aim to identify companies with stable and reliable dividends, as well as a history of increasing or maintaining dividend payments over time. Companies that pay dividends typically belong to mature industries and have established cash flow generation capabilities. These companies often distribute a portion of their earnings to shareholders as dividends, reflecting their financial stability and commitment to rewarding shareholders. When practicing the income dividend investing strategy, investors prioritize stocks with a track record of consistent dividend payments. Benefits of the income dividend investing strategy. Regular income. The primary benefit of the income dividend investing strategy is the regular income stream it provides. By investing in dividend-paying stocks, investors can receive periodic income in the form of dividend payments, which can be particularly advantageous for individuals relying on their investments to cover expenses or supplement their retirement income. Stability. Dividend-paying companies are generally well established and have a history of generating consistent profits. By focusing on these more stable companies, income investors seek to protect their investments from extreme market fluctuations. Long-term wealth building. Through the power of compounding, income investors can reinvest their dividend income to purchase additional shares of dividend-paying stocks. Over time, the compounding effect can significantly enhance the investor's overall returns and accelerate the growth of their portfolio. Diversification. The income dividend strategy encourages investors to build a diversified portfolio of dividend-paying stocks across different sectors and industries. Diversification helps reduce risk by spreading investments across various companies, which can mitigate the impact of individual stock performance on the overall portfolio. Implementing the income dividend investing strategy. When implementing the income dividend investing strategy, investors should consider the following key components. Research and selection. Investors must conduct thorough research to identify companies with a strong dividend track record, solid financial health, and sustainable business models. Fundamental analysis, including examining financial statements and assessing dividend payout ratios, can help investors identify suitable income dividend stocks. Dividend yield. Investors should focus on companies with higher dividend yields, as this indicates a higher potential income stream. However, it's crucial to strike a balance between yield and risk, as excessively high yields may imply financial distress or an unsustainable dividend policy. Dividend growth. While income investors prioritize current income, they should also consider companies with a track record of increasing dividends over time. Consistent dividend growth helps preserve purchasing power against inflation and enhances the compounding effect. Portfolio diversification. Diversifying the income dividend portfolio across various sectors and industries can help reduce risk. By investing in different types of companies, such as utilities, consumer goods, or healthcare, investors can benefit from a mix of stable income sources. Monitoring and rebalancing. Regularly monitoring the performance of dividend stocks is essential to ensure the investments remain in line with the investor's financial goals. If a company decreases or suspends its dividend, investors may need to consider replacing it with another dividend-paying stock to maintain their income stream. Risks of the income dividend investing strategy. While the income dividend investing strategy offers numerous advantages, it's important to be aware of the associated risks. Market risk. Like any investment strategy, income dividend investing is subject to market fluctuations. Dividend-paying stocks can still experience price volatility, and the value of the investments may decrease, potentially affecting the overall portfolio value. Dividend reduction or suspension. Although income dividend stocks are generally considered more stable, companies can reduce or suspend dividend payments in challenging economic conditions. It's crucial to assess the financial health and sustainability of companies before investing. Interest rate risk. If interest rates rise, fixed income investments may become more attractive relative to dividend-paying stocks. This can put downward pressure on stock prices and impact dividend yields. Inflation risk. Dividend income may not keep pace with inflation, which can erode the purchasing power of the investor's income over time. Consideration should be given to choosing dividend stocks with a history of increasing dividends to combat inflation effectively. Conclusion. The income dividend investing strategy is a popular approach for investors seeking a reliable and consistent income stream. By focusing on dividend-paying stocks with a high yield and a history of dividend growth, investors can generate regular income while taking advantage of the power of compounding to build long-term wealth. However, it's essential to conduct thorough research, diversify the portfolio, and monitor investments regularly to mitigate risks and ensure the strategy aligns with financial goals. 11.4 Combining dividend strategies. Combining different dividend strategies can be a powerful approach to maximize your dividend returns. By diversifying your portfolio and leveraging the strengths of various strategies, you can potentially enhance your overall dividend income and long-term growth. In this section, we will explore the benefits and considerations of combining dividend strategies to achieve optimal results. Diversify your dividend portfolio. One of the keys to successful dividend investing is diversification. By spreading your investments across different sectors, industries, and sizes of companies, you can reduce the risk associated with any single stock or sector. Diversification provides a measure of stability and guards against the impact of any unexpected downturns in specific sectors. When combining dividend strategies, it is important to ensure that you diversify not only within each strategy but also across strategies. This means allocating your investments across different types of dividend-paying stocks, such as value, growth, and income stocks. Each strategy has its own unique characteristics and can perform differently under various market conditions. By diversifying your dividend portfolio using multiple strategies, you can potentially benefit from their respective strengths and minimize the impact of any weaknesses. The value of value dividend investing. Value dividend investing focuses on identifying undervalued stocks that offer attractive dividend yields. These stocks are often priced lower than their intrinsic value due to temporary market inefficiencies. By combining the value strategy with other dividend strategies, you can capitalize on the potential for both capital appreciation and regular income. When combining value dividend investing with other strategies, it is essential to perform thorough fundamental analysis and research. Look for companies that not only have high dividend yields but also show strong financial health, sustainable dividend payout ratios, and a track record of consistent dividend payments. By selecting undervalued stocks that have the potential to appreciate over time, you can further enhance your investment returns. Leveraging growth dividend investing. Growth dividend investing focuses on identifying companies that have a history of increasing their dividends over time. These companies tend to have strong earnings growth, solid financials, and a commitment to rewarding shareholders through regular dividend increases. When combining growth dividend investing with other strategies, you can benefit from the potential for both capital appreciation and increasing dividend income. By selecting companies that have a track record of consistent dividend growth and strong fundamentals, you can enhance the growth potential of your dividend portfolio. It is important to assess the sustainability of dividend growth and evaluate the company's future prospects. A well-diversified portfolio that includes both growth and value stocks can provide a balanced approach to dividend investing and the potential for long-term returns. The power of income dividend investing. Income dividend investing focuses on stocks that offer high dividend yields, providing a steady income stream. These stocks are typically from stable and mature companies that distribute a significant portion of their earnings as dividends. When combining income dividend investing with other strategies, you can benefit from the regular income generated by these stocks while also maintaining the potential for capital appreciation. Income dividend investing can provide stability to your portfolio, especially during market downturns. By focusing on stocks with reliable and sustainable dividend payments, you can generate a consistent income stream that can be reinvested or used for other financial goals. When combined with growth and value strategies, income investing provides a well-rounded approach to managing your dividend portfolio. Considerations and caveats. While combining dividend strategies can enhance your overall returns, it is important to consider the unique characteristics and risks associated with each strategy. Each strategy has its own investment requirements and objectives, and it is essential to align your portfolio allocation accordingly. Additionally, it is important to regularly monitor and adjust your portfolio to ensure that your investments remain aligned with your financial goals and risk tolerance. Rebalancing your portfolio periodically can help maintain the desired diversification and adjust for any changes in market conditions or individual stock performance. In conclusion, combining dividend strategies can be an effective approach to maximize your dividend returns. Diversifying your portfolio across value, growth, and income stocks can provide stability, growth potential, and regular income. By leveraging the strengths of each strategy and carefully managing your investments, you can optimize your dividend portfolio and work towards achieving your financial objectives. 12. Monitoring and adjusting your dividend portfolio. 12.1 Importance of portfolio monitoring. Once you have built a dividend portfolio and implemented various strategies to maximize your returns, it is crucial to regularly monitor and assess the performance of your portfolio. Portfolio monitoring plays a vital role in ensuring that your investments are aligned with your goals and that you can take appropriate actions to manage and optimize your dividend returns. Understanding the purpose of portfolio monitoring. The primary purpose of portfolio monitoring is to keep track of the progress and performance of your dividend investments. By monitoring your portfolio, you can evaluate dividend performance. Regularly assessing the performance of your dividend stocks allows you to identify which companies are effectively delivering consistent and growing dividend income. It helps you understand the return on your investment and determine the effectiveness of your dividend growth strategies. Identify portfolio strengths and weaknesses. Monitoring your portfolio enables you to recognize which sectors or industries are performing well and which ones may be underperforming. By identifying these strengths and weaknesses, you can make informed decisions on whether to reallocate your investments or adjust your portfolio composition to maximize dividend returns. Manage risk. Portfolio monitoring helps you stay informed about potential risks in your dividend portfolio. By monitoring factors such as industry trends, economic indicators, and company-specific news, you can proactively respond to any potential risks that may affect your dividend income. This allows you to protect your portfolio from unexpected downturns and minimize the impact on your returns. Track dividend growth. By monitoring your dividend portfolio, you can track the growth of your dividends over time. This allows you to assess the effectiveness of your dividend growth strategies and identify patterns or trends in your dividend income. Tracking dividend growth is essential for long-term investors who aim to build a sustainable income stream. Stay informed. Regular portfolio monitoring helps you stay informed about the overall market conditions, trends, and changes in the regulatory and economic landscape. This knowledge allows you to adapt your investment approach, adjust your portfolio composition, and capitalize on opportunities that may arise in the market. Key metrics to monitor. When monitoring your dividend portfolio, there are several key metrics and aspects to consider. Dividend income. Keep track of the dividend income generated by your portfolio. Monitor the individual dividend payments received from each stock and calculate your overall dividend income. This provides you with a clear understanding of your cash flow and the income generated by your investments. Dividend growth rate. Track the growth rate of your dividends to evaluate the performance of your dividend growth strategies. Compare the growth rates of different stocks within your portfolio and assess whether they align with your expectations and long-term goals. Total return. Monitor the total return of your portfolio, which includes both dividend income and capital appreciation. Assessing the total return allows you to gauge the overall performance of your portfolio and determine its effectiveness in generating wealth over time. Sector industry performance. Stay updated on the performance of different sectors or industries in your portfolio. This helps you identify potential risks or opportunities arising from specific sectors and allows you to rebalance or adjust your portfolio allocation accordingly. Diversification. Monitor the diversification of your portfolio to ensure that you have a well-balanced mix of dividend stocks across various sectors and industries. Diversification helps reduce risk and provides stability to your portfolio. Establishing a monitoring routine. To effectively monitor your dividend portfolio, it is important to establish a monitoring routine that suits your investment style and goals. Here are some guidelines to help you establish an effective monitoring routine. Frequency. Decide on the frequency of monitoring that suits your needs and investment horizon. Some investors prefer to monitor their portfolio on a weekly basis, while others may prefer a monthly or quarterly review. Find a balance that allows you to stay informed without becoming overwhelmed by day-to-day fluctuations in the market. Set clear objectives. Define your monitoring objectives based on your investment goals. For example, if your primary goal is to generate a stable income stream, focus on monitoring and evaluating the dividend income and growth of your stocks. If your objective is long-term capital appreciation, assess the overall performance and total return of your portfolio. Utilize tools and technology. Take advantage of various online tools, financial software, or mobile applications that can assist in monitoring your portfolio. These tools can provide real-time updates, track performance metrics, and offer insights into your investments. Stay informed. Regularly read financial news, company reports, and industry publications to stay informed about relevant market trends and developments. This information will enable you to make informed decisions regarding your portfolio. Review and adjust. Periodically review your portfolio and make necessary adjustments based on your monitoring findings. Reassess your investment thesis. Consider rebalancing your portfolio allocation, or make strategic changes to optimize your dividend returns. By implementing a systematic monitoring routine and regularly evaluating the performance of your dividend portfolio, you can make informed decisions to enhance and maximize your dividend returns. Remember, effectively monitoring your portfolio is an ongoing process that requires staying informed, adapting to market conditions, and proactively managing risk and opportunities. 12.2 Tracking dividend performance. Tracking dividend performance is a crucial aspect of dividend investing. By monitoring the performance of your dividend portfolio, you can assess the effectiveness of your investment strategy, make informed decisions, and maximize your dividend returns. In this section, we will discuss the importance of tracking dividend performance and provide strategies for effectively monitoring your dividend investments. Importance of tracking dividend performance. Tracking the performance of your dividend portfolio allows you to evaluate the success of your investment strategy and identify areas for improvement. Here are some key reasons why tracking dividend performance is essential. Assessing dividend growth. Dividend growth is an important metric for dividend investors. By tracking dividend performance, you can monitor the growth rate of your dividends over time. This helps you determine if the companies in your portfolio are consistently increasing their dividend payments, which is a positive sign of financial health and shareholder value. Measuring dividend yield. Dividend yield is another critical factor to consider when investing in dividend-paying stocks. By tracking dividend performance, you can calculate and assess the dividend yield of your portfolio. This enables you to compare the income generated by your investments to other investment options and market benchmarks. Identifying dividend cuts. Occasionally, companies may reduce or suspend their dividend payments. Tracking dividend performance allows you to quickly identify any dividend cuts in your portfolio. By being aware of these changes, you can take appropriate actions such as reassessing the company's financials, evaluating the sustainability of the dividend, and considering potential replacements if necessary. Managing dividend reinvestment. Dividend reinvestment is a powerful strategy to maximize compounding returns. By tracking dividend performance, you can accurately assess the amount of cash dividends received and reinvest them promptly. This ensures that your reinvestment strategy aligns with your investment goals and allows you to benefit from the compounding effect over time. Strategies for tracking dividend performance. Now that we understand the significance of tracking dividend performance, let's explore some strategies for effectively monitoring your dividend investments. Dividend tracking spreadsheet. One of the simplest and most effective ways to track dividend performance is by using a spreadsheet. Create a spreadsheet where you can input the dividend payments received from each company in your portfolio. Include important details such as dividend dates, amounts, and the corresponding stock's performance. This allows you to easily track the growth of your dividends and analyze trends over time. Dividend tracking apps. There are several dividend tracking apps available that can help you streamline the process of monitoring your dividend investments. These apps provide features such as dividend tracking, portfolio valuation, performance analysis, and dividend calendar alerts. Explore different apps and choose one that suits your needs and preferences. Brokerage account tools. Many brokerage platforms offer robust tools and features to track dividend performance. Take advantage of these tools within your brokerage account to monitor your dividends, analyze performance, and receive detailed reports. These tools often provide comprehensive dividend information, including historical dividend payments, dividend growth rates, and dividend yield. Dividend news and websites. Stay informed about dividend-related news and developments in the market. Websites and financial news platforms often provide valuable insights on dividend-paying companies, dividend trends, and announcements of changes in dividend policies. Keeping up to date with dividend news helps you stay ahead and make informed decisions regarding your dividend investments. Analyzing and interpreting dividend performance. Tracking dividend performance is not just about collecting data, it also requires analysis and interpretation. Here are a few key points to consider when analyzing and interpreting dividend performance. Consistent dividend growth. Look for companies with a consistent track record of increasing dividends over time. Companies that consistently raise their dividends demonstrate financial strength and commitment to shareholder value. Assess the dividend growth rate and evaluate if it meets your investment objectives. Dividend coverage ratio. Calculate the dividend coverage ratio, which measures the company's ability to cover its dividend payments from its earnings. A high coverage ratio indicates that the company has sufficient earnings to support its dividend payments. A low coverage ratio may suggest a potential risk of dividend reduction or suspension. Dividend yield comparisons. Compare the dividend yield of your portfolio to relevant benchmarks, such as the dividend yield of the overall market or sector-specific indexes. This helps you assess if your portfolio's dividend yield is competitive and provides a basis for comparison with other investment options. Dividend sustainability. Evaluate the sustainability of the dividend payments by analyzing the company's financials, cash flow, and earnings growth. A sustainable dividend is one that has a strong likelihood of being maintained or increased in the future. By tracking and analyzing dividend performance, you can make informed decisions and optimize your dividend investing strategy. Remember that dividend investing is a long-term approach, and monitoring your dividends regularly allows you to stay on track and maximize your returns over time. 12.3 Rebalancing your dividend portfolio. Rebalancing your dividend portfolio is an essential step in maximizing your returns and managing your investment risk. While dividends provide a steady income stream, the performance of individual stocks and sectors can vary over time. By periodically rebalancing your portfolio, you can ensure that it remains aligned with your investment goals and maintains an optimal allocation. The importance of rebalancing. Over time, the stock market experiences fluctuations, and the performance of different asset classes can diverge. As a result, the initial portfolio allocation you set may shift significantly after some time. Failing to rebalance your portfolio can leave you exposed to excessive risks or prevent you from capitalizing on potential opportunities. Rebalancing involves selling a portion of your investments that have grown in value and reallocating those funds into assets that may have underperformed. By doing so, you bring your portfolio back to its original allocation or adjust it to reflect changes in your investment strategy. Rebalancing allows you to buy low and sell high, which is a fundamental principle of successful investing. Determine a rebalancing strategy. Before diving into the process, it's important to establish a rebalancing strategy that aligns with your investment goals and risk tolerance. There are two primary approaches to rebalancing. Time-based rebalancing. This method involves setting a predetermined interval, such as annually or semi-annually, to rebalance your portfolio regardless of market conditions. By following a time-based approach, you ensure that your portfolio remains in line with your target asset allocation over the long term. Threshold-based rebalancing. With this approach, you establish specific thresholds or tolerances for each asset class or individual stock. When an asset's allocation deviates significantly from its target percentage, you trigger a rebalancing action. For example, if your target allocation for a particular stock is 10%, but it grows to 15% or falls to 5%, you rebalance to bring it back in line. Both methods have their merits, and the choice ultimately depends on your individual circumstances. Time-based rebalancing provides a systematic and disciplined approach, while threshold-based rebalancing allows for more flexibility and responsiveness to market conditions. Steps for rebalancing. Rebalancing your dividend portfolio involves a series of steps to ensure a smooth and efficient process. 1. Review your investment goals and risk tolerance. Begin by revisiting your investment goals and risk tolerance. This step allows you to reassess your portfolio's target asset allocation and determine if any adjustments are necessary. Consider factors such as your investment time horizon, income needs, and risk tolerance to establish a suitable allocation strategy. 2. Analyze your current asset allocation. Next, evaluate your existing asset allocation to identify any deviations from your target percentages. Examine each asset class and individual stock to understand how their current values compare to your desired allocation. Look for significant disparities that may require rebalancing. 3. Determine the rebalancing approach. Decide whether you will follow a time-based or threshold-based rebalancing approach. Consider your investment goals, risk tolerance, and the level of market volatility. Choose a method that best suits your needs and aligns with your overall investment strategy. 4. Decide which assets to rebalance. Based on your analysis and chosen approach, determine which assets need to be adjusted. Take into account the investment performance, current market conditions, and the impact of potential rebalancing transactions on your tax situation. Prioritize assets that deviate the most from your target allocation. 5. Execute the rebalancing trades. Once you have identified the assets that require rebalancing, execute the necessary trades. Sell a portion of the overperforming assets and use the proceeds to purchase assets that have fallen below their target allocation. Be mindful of transaction costs, taxes, and any potential impact on your portfolio's overall diversification. 6. Monitor and repeat. After rebalancing your portfolio, continue to monitor its performance and asset allocation. Regularly assess the need for future rebalancing to ensure that your portfolio remains aligned with your investment goals. Rebalancing should not be a one-time event but rather an ongoing process to maintain a well-diversified and optimized dividend portfolio. Final thoughts. Rebalancing your dividend portfolio is a crucial aspect of maximizing your returns and managing risk. By periodically reviewing and adjusting your asset allocation, you can ensure that your portfolio remains aligned with your investment objectives. Whether you choose a time-based or threshold-based approach, regularly monitoring and rebalancing your portfolio will help you stay on track and make informed investment decisions. Remember to consider your individual circumstances, risk tolerance, and long-term goals when establishing a rebalancing strategy. 12.4 Making informed investment decisions. When it comes to maximizing dividend returns and making informed investment decisions, there are several important factors to consider. Dividend investing is not just about passively receiving regular income from your investments, it also requires active decision-making and monitoring to ensure that your portfolio is optimized for long-term growth and profitability. In this section, we will explore some key strategies and considerations that can help you make informed investment decisions and maximize your dividend returns. Develop a deep understanding of the company. Before investing in any dividend-paying stock, it is crucial to develop a deep understanding of the company. This involves conducting thorough research on the company's business model, financial health, management team, competitive position, and future prospects. By gaining a comprehensive understanding of the company, you can assess its potential for sustainable dividend growth over the long term. Analyze dividend metrics. To make informed investment decisions, it is essential to analyze various dividend metrics. These metrics provide valuable insights into the company's dividend-paying history and its commitment to shareholders. Some key dividend metrics to consider include the dividend yield, dividend growth rate, payout ratio, and dividend coverage ratio. By evaluating these metrics, you can assess the company's ability to generate consistent and sustainable dividend income. Evaluate the company's dividend growth potential. Dividend growth investing focuses on investing in companies that have a track record of consistently increasing their dividends over time. When assessing the dividend growth potential of a company, consider factors such as the company's historical dividend growth rate, earnings growth rate, cash flow generation, and future prospects. Look for companies that have a history of increasing dividends even during challenging economic periods. Assess the company's financial stability. Investing in financially stable companies is crucial for maximizing dividend returns. A financially stable company is more likely to continue paying dividends consistently and weather economic downturns. Assess the company's financial stability by analyzing its balance sheet, debt ratio, cash flow position, and overall financial health. A company with low debt, ample cash reserves, and a strong balance sheet is more likely to maintain and increase its dividends in the future. Consider the sector and economic trends. The sector in which a company operates can significantly impact its ability to generate sustainable dividend income. Different sectors perform differently during various economic cycles, and it is important to consider these trends when making investment decisions. Some sectors, such as utilities and consumer staples, tend to be more defensive and less prone to economic volatility. On the other hand, sectors like technology and healthcare may offer higher growth potential but can be more volatile in terms of dividend payments. Understanding the sector dynamics and economic trends can help you make informed decisions about which dividend stocks to invest in. Monitor market conditions. Monitoring market conditions is crucial for making informed investment decisions in the dividend investing space. Keep an eye on factors such as interest rates, inflation, geopolitical events, and overall market trends. Changes in these factors can impact the overall health of the economy and subsequently affect dividend payments. For example, rising interest rates can increase borrowing costs for companies, potentially impacting their ability to maintain or increase dividend payments. Staying informed about market conditions can help you adjust your investment strategy accordingly. Diversify your dividend portfolio. Diversification is a fundamental principle of investing that helps manage risk and maximize returns. It involves spreading your investments across different sectors, industries, and even countries. By diversifying your dividend portfolio, you can reduce the impact of any individual stock or sector on your overall returns. This strategy helps smooth out volatility and provides a higher probability of consistent dividend income, even if one or two investments experience challenges. Regularly review and rebalance your portfolio. Making informed investment decisions involves regularly reviewing and rebalancing your dividend portfolio. As economic conditions, market trends, and company performance change, your portfolio's composition may need adjustment. Regularly review your investments and assess whether they are aligned with your investment objectives and risk tolerance. Rebalancing involves buying or selling stocks to restore your original allocation. This process ensures that your portfolio remains in line with your investment strategy and helps maximize overall dividend returns. Seek professional advice if needed. If you are new to dividend investing or feel overwhelmed by the complexities of making informed investment decisions, seeking professional advice may be beneficial. Financial advisors specializing in dividend investing can provide guidance on selecting dividend stocks, constructing a diversified portfolio, and making strategic investment decisions. They can help analyze your financial goals, risk tolerance, and time horizon to develop a personalized investment strategy that maximizes dividend returns while aligning with your specific needs. In conclusion, making informed investment decisions is a crucial aspect of maximizing dividend returns. By developing a deep understanding of the companies you invest in, analyzing dividend metrics, assessing financial stability, considering sector and economic trends, monitoring market conditions, diversifying your portfolio, and regularly reviewing and rebalancing your investments, you can optimize your dividend investing strategy. Remember that dividend investing requires patience, discipline, and a long-term perspective. With careful research and analysis, you can make informed investment decisions that lead to consistent and growing dividend returns over time.